Yes, Mr Hodge.
Commissioner, the first witness today is Andrew Thorburn.
Mr Thorburn, would you be good enough to come into the witness box? And can I begin by, just before you sit down, can I begin by asking whether you'd prefer to make an oath or take an affirmation?
An oath, please, Commissioner.
And swear the witness, please.
I swear by Almighty God
I swear by Almighty God
that the evidence I shall give
that the evidence I shall give
will be the truth,
will be the truth,
the whole truth,
and
nothing but the truth.
and nothing but the truth.
Thank you very much, Mr Thorburn. Do sit down. Yes, Ms Harris.
Thank you, Commissioner. Mr Thorburn, your full name is Andrew Gregory Thorburn,
It is?
and your business address is Level 3, 700 Burke Street, Melbourne.
Yes, it is.
And do you appear today in response to a summons issued by the Royal Commission?
Yes, I do.
Do you have that summons with you in the witness box?
I do.
Commissioner, I tender the summons.
The summons to Mr Thorburn will be Exhibit 7.79.
Mr Thorburn, have you made two statements in response to the Commission's rubric 713, a principal statement and then a short supplementary statement?
I have.
And the short supplementary statement corrects, does it not, an error in the compilation of the exhibit to your principal statement?
Yes, it does.
Do you have those statements and their exhibits in the witness box with you?
Yes, I do.
Mr Thorburn, are there any amendments that you wish to make to either of those statements?
None.
Commissioner, I tender those statements. There are two. The first is the principal statement of 19 November 2018. The second is the supplementary statement of 24 November 2018, together with exhibits.
The first of those statements and its exhibits is Exhibit 7.80. The second supplementary statement and its exhibits is Exhibit 7.81.
Commission
Thank you,
closes.
Ms Harris. Yes, Mr Hodge.
Thank you, Commissioner. Mr Thorburn, you're the CEO and Managing Director of the National Australia Bank,
Yes, I am.
and you've led the executive, or you lead the executive leadership team and manage the business and operations of the NAB Group.
Yes, I do.
And you were appointed to your current position in August of 2014,
That's correct.
and you were at the National Australia Bank since about 2005.
Yep, that's correct.
And then before then, you'd worked in other banks, including CBA and St George.
That's correct.
What I wanted to start by asking you about, Mr Thorburn, was the letter that you personally wrote to the Commission and that came at the beginning of the submission that the National Australia Bank made in response to the interim report. And Commissioner, that is POL.910.0001.1010_0001. If we go over to the second page, we see your letter, or the beginning of your letter. Mr Thorburn, have you got a
Can I just
hard
check what
copy
tab?
there?
Is that in my tab here?
I'm not sure that it's in your...
Okay, it's fine. I can see it on screen. That's fine. Yep, I'm familiar with the letter.
And one of the points you make at the bottom of that first page is that in your view there are four, or at least four, significant changes which have occurred inside banks over the last 30 years and that help to explain why things have gone wrong. And I'll just take you through the four of them. The first change you identified was that focus has shifted away from customers, leaving the industry open to the challenge that it puts profits before people.
Yes.
And then over the page, the second change you identified was the move from a long-term view to a short-term one.
Yes.
The third change you identified was that there was a move from base pay to greater incentive compensation. And you said that this had led to most people receiving variable rewards calculated by reference to short-term considerations.
Mm-hmm.
And the fourth change that you identified was that banks have become more complex. And you said this was partly due to increasing regulation and compliance obligations.
Yes.
And as to the first change, you make the point that if we get the customer experience right, if we serve our customers' interests well,
Yes.
we will build a sustainable business
Yes.
for all stakeholders.
Yes.
And I just want to start by trying to understand that point and what you mean by a sustainable business.
Well, Mr. Hodge, I think all businesses have got to start with focusing on your customers and the products and services you bring to them to help them achieve their goals. And that should be the primary focus of a bank. And when I started in banking, that was indeed the sole focus. And there are, of course, other things that are important. Risk management, growth in profits, they're all important. But particularly the profits piece, they come as a result of you focusing on your customers, earning their trust, so they stay with you and do more business with you because you're serving them well. And that should be the primary focus of any business, including a bank.
And your identification of this as the first change, does that carry with it the implication that you think in part some of your business, the NAB business, has become unsustainable?
Well, yes, I think if you go to my other points where I talk about becoming short-term, focus too much on the next 6 or 12 months, focus too much on the profit, which is the outcome of serving the customer well, then I think you start to build some unsustainable foundations. You don't invest enough, you don't listen to customers enough, and the mindset of the leaders is not about 3 to 5 years and being stewards of, I took the baton in August 14, this company's been going 150 years, and my role should be to make it stronger and better for the long run, not just for the next 1 or 2 or 3 years. So I think, yes, that does cause some of this drift that I referred to.
So one respect in which you think the current business is not sustainable is to continue to focus on the very short term?
Yes, yes.
And another issue that I think you were trying to highlight was that part of this is a move towards a sales culture.
Well, I don't think I said that in there, but yeah, I think you're correct. I think that started to happen. That was like a symptom of focusing on the short term, focusing too much on growth, short-term growth that's not really sustainable, and a sales culture was introduced, not just in our bank, in the system. And I think that created wrong outcomes as well, unintended consequences.
And does it also follow then that an aspect of modern banking in Australia that you think is unsustainable is the continuation of that sales culture?
Yeah, I think if you have that in your bank and it's not focused, so I don't think sales shouldn't be a term we use or a mindset. What you should be thinking of is understanding your client, understanding their needs, understanding their financial situation, and bringing your products and services to help them achieve their goals. That should be the purpose of building a relationship with clients. And in so doing, you build a long-term relationship with that client. And yes, you'll get more business, but that's a byproduct, an important byproduct of that process of caring for your client and being a steward and a partner.
I want to come back to that point in a moment. What I wonder is whether somebody listening to the points that you're making might think that what you're advocating for is a shift toward, or some would probably say back to, a more service-oriented and utilitarian view of banking.
Well, I think definitely a shift back to, we can't go back. We've got to go back in some ways, but we can't because the world has changed so fast and there are so many different technologies now and competitors. So I'm not harking to the past for anything other than getting the basics right about it should be service-based, it should be relationship-based, it should be stewardship-based, it should not be sales-based. And I think, Mr. Hodge, if we don't do that inside our company and in the sector, we will continue to make mistakes and be exposed because it's not really sustainable. Now, I'm not saying that growing your business isn't important, but your motivation must be to look after your client. That's the primary objective.
Well, let's just tease that out. Presumably, the reason for growing your business is to generate and increase the amount of profits that the business is making.
Well, I think that's one of the important goals of any organisation. I mean, shareholders provide you capital, and in a case of a bank, it's very important. So yes, a sustainable quality return over time through cycles is what we should be doing for shareholders. Yes, and that's important.
And the generation of profits is in the shareholders' interests.
Well, obviously it's in the shareholders' interest if it's quality and sustainable, not if it's not. And in our case, we pay out 80% of our profits to our shareholders, nearly 600,000 Australians. So that's important. But what a profit does makes you viable, means you can raise debt overseas. It means you can invest in new products and services and better compliance systems and better technology. So it's not just in the interests of shareholders, it's in the interests of building a sustainable company. And customers actually ultimately one of the very important beneficiaries of that.
I'm not sure we're really disagreeing. I think the point you're trying to make is it's one thing to say it's in shareholders' interests to make profits, but to speak of that in terms of just the profit over 1 year or 3 years misses the point that you're trying to cater to shareholders who are in there for the longer term.
Yes, that's right. Yes.
And that it might not be in the interests of a shareholder who's going to hold shares in your bank for 5 years or 10 years for you to do things now that will generate an immediate profit but will have significant repercussions in the future.
Yeah, especially if those actions are not based on building trust with clients and sustainable.
And one of the points that then seems to come out of that is that the need to produce a profit can motivate both good and bad behaviours.
Yes, it can.
And you would say, I think, that if you offer good products and good service, then that will attract and retain customers and in that way make profits for your shareholders.
Absolutely. Yep.
And that's the type of sustainable business that you want to achieve.
Yes, absolutely.
And if your business doesn't have effective controls, then the problem that might create is that it will then engage in risky behaviour that will generate a profit but is not sustainable in the long term.
That's correct. And also, you will make mistakes which will damage your customer experience. You will make mistakes such that your reputation as an organisation of being trustworthy also gets damaged. Yeah.
That's right. There's a lot of consequences of not having sufficient controls. One is that you will likely at some point in time have to remediate and make good any loss that you've caused to other people.
That's correct, yes.
Another consequence is that in general it will damage your reputation and your brand, and that then means you won't attract as much business.
Yes, and also you've got to think of your people. We've got 33,000 staff. I mean, they should be proud bankers who live in the way that I talked about, Mr. Hodge. And if you make mistakes like that, they can lose confidence too.
Now, as to the second issue that you identify in your letter, which is focusing on the short term rather than the long term, what do you think has been the cause of that?
Well, I think there are two broad causes. The first is the world has got faster. You know, people want things now. When you push your button on Uber, you expect it to turn up. Like 5 minutes is a long time. You know, people can communicate via Snapchat, all sorts of things like that. So the world's just the cycle. Expectations of things happening right now, for me, immediately, have gone up. And if you're building a long-term business, that can't be always the way you respond to the signals. The second thing is that my view is as the banks got very significant in Australia in terms of their market capitalisation, and in fact tracking the index every day and tracking share price is a good example of the first point. You know, has my wealth gone up or down, and really you shouldn't be thinking of it like that if you're a bank shareholder. Markets became the focus. Quarterly earnings and updates became the focus. Half-year updates, repeat. And then, I think, Mr. Hodge, one of the things that came into play, which I think has caused a really significant impact, that has been that incentives for executives started to be locked onto that cycle. And then you're in a cycle of executives looking at 1 and 2 and 3 year returns and really thinking about shareholder return, not about the broader metrics and reputation of your business, which really is what you should be focused on.
Let's try to explore some of those ideas. As to the first idea that the whole world has got faster, I'm not sure I really understand that proposition. Presumably, how your bank is managed is ultimately a question for you and your ELT.
Yes?
Without wanting to be unfair, there's not going to be that many millennials in your ELT, I would imagine. None, I would suspect.
Lots of millennial clients.
Sure, but you are the ones who are making the decision
Absolutely.
as to how you're going to manage the business. You're surely not saying you and your executives have just got caught up in the world being faster and that's caused you to manage for the short term.
Yeah, well, when I said that was one of the causes, I think the expectations of having new products and services out in the market quickly to cater for increasingly granular subsets, I am saying that expectation has created the expectation that we can move faster, and yet if you're not investing in new and modern technology enough, your technology systems can't keep up with it.
So the idea is there's increasing identifiable demand for subsets of customers in the market for new products for those customers. Is that the first proposition?
Yeah, sorry. My broad point on the first one is I think the expectations of the bank and companies being able to innovate and move into the market with new products and services has become heightened. And if you don't have that, somehow your brand is seen to be lagging. And that's fueling, let's introduce new products and services more quickly. That was my first point.
All right. I just wonder whether the real issue that you're trying to get at is the second point, and that is that you are in a situation where your shareholders are looking at your share price performance daily and looking at your quarterly updates and your half-yearly updates and your annual updates, and then your senior executives' remuneration has been tied in the past to that sort of performance, and that means everything gets focused on a very short-term view of what's happening with your share price.
Well, I agree with all you said, apart from the inference that maybe it's the shareholders' fault, and I don't think it is. I think it's the role of the CEO and the board and the management, actually, as per your challenge in the first point, to manage the business steadily, with good principles, good risk management, good leaders, good product development, quality. And so, we're being buffeted by that. We have responded to that, but actually, and that's our bad. I'm not blaming shareholders for that.
I think your point is the shareholders may or may not be focused on the short term, but the board and the executives ought to be able to focus on the long term, regardless of what the shareholder focus is.
Yep, that's a good conclusion. Yep.
And that to the extent then that there has been, as you've said, a shift towards focusing on a very short-term view, that must therefore be a failing of the board and the senior executives.
Yeah, I think it's a common failing, and I don't think it's intentional. I think one of the things that, in writing this letter to the Commissioner, I've really reflected on a lot of what's happened this year, and the Commissioner's brought things right in front of me, and I've reflected on things I hadn't before. Yet I've been a banker over 30 years. So I think it's not happened intentionally. It's just been a drift that has happened, and it should be the accountability of the board and the CEO and the management to make sure that in the future that doesn't happen as much.
And how does it get fixed then? It's all very well to say it shouldn't happen in the future, but it's happened, you say, unintentionally in the past. So how do you address it?
Well, the first thing is you need to come back to why the company exists. You need to go back to the first touchstone, and in our case, our purpose, to back the bold who move Australia forward, or our vision, both of which have been approved by the board, which is to be trusted by customers for exceptional service. So you've got to come back to why do we exist and what is our vision? Now, our purpose is a 50-year thing and our vision should be at least 5 years. So I think the first thing is you've got to come back to those basic and fundamental questions. The second thing is you need to be investing increasingly in better systems, better risk tools, better product development, new and modern systems which enable you to keep your investment fairly steady, not less and more, so that you're building quality over time. And the third thing is you need to get your measures and incentives. You know, one of the very important drivers of the human system inside any company are lined up to the first point. And so I think we've made some ground here. We need to do more. So if you go to measures now and you look at our people, they have 4 or 5 key result areas. It must have customer, it must have risk. It should have financial as well. I think that's really important, but it's got to have balance in it. And secondly, on incentives, you know, we have moved nearly all our people off those shorter term sales incentive scheme, which encourage, going back to your word, sell, achieve volume, get rewarded. And so now we've moved people onto an annual variable reward scheme, which means that they need to achieve performance across a number of measures. And increasingly, particularly for senior people, any incentive is deferred. In the case of myself and our executives, 60% for 4 years. So I think those sort of things start to move us towards thinking and having symbols and controls that help us achieve what you asked.
Can we just take the 3 points that you raised in turn? The first was you made the point about having a vision and a purpose. I think I might confuse them. A vision should be for 50 years.
No, other way around.
Sorry,
Purpose
purpose should be for 50
yeah.
years, vision should be for 5
Yeah.
years. Presumably, whatever those terms mean in any particular way, that's not a change for the bank. The bank must have always had a vision and a purpose.
Well, in the last 2 years, the purpose and vision have been, we never had a purpose. And our chairman and myself led that work inside the company to work out what is our purpose. And I think it was very thorough and very disciplined. We went back and looked at a lot of artefacts, and there's even been books written on the bank about why we existed, because you've got to go right back to where we are at our best. So the purpose is new. It was approved 2 years ago. The vision was renewed this year.
All right. It sounds so complicated when you say it, but you're a bank. Presumably your purpose is to be a bank. Is it?
Yeah.
Is that?
Yeah. Well, yes, but you need. What is a bank and what does it do? So what the purpose says and the vision say about how that should happen. So take the purpose, backing bold people, often business people, because those people actually move our country forward, and that's actually what the bank should be about. And the vision, to be trusted by customers for exceptional service. Yeah, so you've got to click down from the bank because we feel we need a few more descriptors for our people to make it clear how we want to be and why.
And we might come back to this when we come to your fourth point, but it seems like as a bank, your purpose would be to take deposits and lend money and to do that as well as you could. Is that oversimplifying
I think
what you should
that's
be
the
doing?
functional activities of a bank.
All right.
But all banks do that. If you can have a purpose and a vision that really orientate your people from their head and their heart to living the purpose and vision, I think you start to bring the experience into play so that you serve your clients in that way, and hopefully you're an even better bank than others. So they're two separate things, sort of the activities of banking, which is what you described, and more what you stand for and how your people interact with clients and why they come to work to do what they do every day.
And then I was just checking that I had this right, but the second point that you made, or the second change you needed to make, was to invest in your systems and processes. And I think you were saying make consistent investment,
Yeah.
is that right?
Yeah.
And has that been a problem for your bank, making consistent investment in the necessary systems and processes?
Well, I think we've made reasonably consistent investment over the last 5 to 7 years. I think prior to that, unfortunately, we had some issues which meant that too much of our investment was going into fixing businesses that ultimately ended up being divested, in the UK in particular. So that distracted us a lot. But I think in the last 5 to 7, we have invested more. Now, I think some of that hasn't entirely worked. You know, they're big projects and they don't always deliver what you expect. But late last year, at the end of the 2017 financial year, for the previous 6 months, myself and our executive team and the board have been talking about how do we start to think about the longer term future. Not just the next 1 or 2 years, but the next 3 to 5. And we saw some considerable changes coming. This was before the Royal Commission. And we elected as a company to invest, we normally invest around $1 billion a year, to increase that over the next 3 years by $500 million per annum. So a collective impact of $1.5 billion more, because we felt we needed to modernise the bank, address legacy systems, improve controls, improve product development, and start to address a number of these issues. So we have increased considerably for 2018, 19 and 20, our investment in these sort of activities. And then we're going to have to review it at that time, because we're going to have to continue to invest to make the bank strong. And I think that's a good example of us trying to preemptively think about stepping into it and investing more to make the bank simpler.
The third idea or point that you made was about remuneration, and you spoke about that at some length. And that seems to, in the end, be the most significant issue. You want to align the remuneration of your executives and your staff with the outcomes that you're trying to achieve.
Yeah, I think I mentioned 2 bits, the measures, like how are you measured in your job, 1, and 2, then the incentives, or if you do receive an incentive, what it's paid for and over what time period. Because one of the points I make in my note, Mr. Hodges, you've drawn us to, is that when I started in banking, it was just fixed pay. And progressively, incentives and variable pay have become more and more significant. And so I think that is one thing that we do need to address, and I think we've made good steps, with more to come, I'm sure.
That's the third reason you raise in your letter, and I will come to that in a moment. Can I just ask you to focus on one thing, and that is about vesting of remuneration. You made a point, which is there's now been a change for your senior executive leadership team, so that 60% of your variable remuneration will vest.
Is deferred for 4 years.
4 years. Yeah. And is that part of, is that part of making sure that you and your executive leadership team are focused on what the outcomes will be in 4 years' time, rather than the outcomes now or for next year?
Well, I think there are a number of reasons we did it. The first one is this point, that you want executives to be thinking about longer term. And so each year, if you get incentive, it's rolled out. So you've got, 4 years and then another year. And so you're getting people to think about the longer term. And because it's vested in the bank shares, obviously you're trying to think of how do we run this business in the longer run to improve our value for shareholders, because I'm a shareholder. So I think that's the first reason. The second reason is it is a bare requirement now. Now, it's a bare requirement for me, but actually we decided to do it for our whole executive team. That's the second reason.
And in terms of the conditions on the vesting of that sort of deferred award, is it an issue to make sure that there are realistic conditions on whether it vests or not?
Yes.
And maybe perhaps if I help you out with this, one of the issues for NAB in the past, I think, has been that the vesting of LTIs has been very rare
Yeah.
over the last few years.
Yeah.
Do you agree?
Yes, I do.
And that presumably is because whatever the conditions for vesting are have just not been able to be satisfied.
That's correct.
And a consequence of that, I would assume, is that you and your senior executives probably don't think of that sort of deferred long-term incentive as something you're really going to get if the conditions are unrealistic for vesting.
Yeah, although the terms of those were clear and they're set by the board and the shareholders, but they've really been around shareholder return.
Mm-hmm.
That's been the main item that's been measured on.
And the change that's being made to the system, those sorts of shareholder return conditions, they won't apply anymore, will they, to the deferred?
No, that's correct. The total compensation's come down. It's become potentially more certain. It's deferred for longer. And then if the executive is there in 4 years, and there's no other, I think one of the other items that's always looked at, and I think increasingly so, is there any reason why this should not vest for the executive? So if it is going to vest, the board still has at their discretion to not vest it, and they've exercised that in recent times and this year in particular. So it can be withdrawn, is what I'm saying, by the board at its discretion.
And so what you're hoping that you've moved from is, on the one hand, a system where there were LTIs, but given the TSR metric that was used, it was unlikely that they were going to vest, and as time went on each year, you'd know those LTIs are probably not going to vest. That seems to have been the realistic situation you were in. Do you agree?
Yeah, well, there's two bits of variable reward we previously had, Mr. Hodge. The first was deferred STI, so that was like the shorter term bonus that was deferred for 2 years. That wasn't subject to shareholder hurdles or TSR. It was the LTI component.
Yep.
Now, I think just to come to your point around, I mean, I just think about the way I think about it. It was to me more a recognition that if we over time achieved the shareholder return, we would get it. But if we didn't, we wouldn't. So to me, it wasn't, I didn't think of it as realistic or unrealistic. To me, it was just something, it didn't change the way I did my work. And if it happened, then that was good. If it didn't, so be it. So it wasn't something I thought of as unrealistic or realistic, is all I'm just trying to push into.
I understand.
Is that, yeah.
The change, from your personal perspective though, the change that has been made is something that you think will refocus you
Yes.
and your executive
Yes.
leadership team on the long term.
Yes, I do.
Now, if we then move to the third change that you identify, which is the move away from fixed pay.
Yeah.
And why is it that you think that move occurred?
Well, there'll be a bit of chicken and egg here, so just bear with me as I try to get this, how I explain it. So the first thing is the bank became more focused on growth. The bank became more focused on in-year profits. And it started as a tool to align and maybe motivate and incentivise the leaders to actually be aligned, very aligned with the shareholders, and earning additional pay over and above what they could if they achieved those goals. So I think that's the first point. The second point is, deregulation, was occurring and continued to occur. You had foreign banks and coming in, and the competition for talent, to get the best people into your company and keep them there. I think this was used as a tool to incentivise people to come to your organisation or to stay with your organisation. And I think even as a subset of that, banking is a global industry. Some core banking skills you can get right in the Australian market, frontline bankers and things like that. But when you look at technology and data and artificial intelligence and robotics and those sort of things now, it's a global pool. So if you want the best people, which we should for our customers and shareholders and the company, you're going into a global pool, not just in banks, IT companies. So in a way, your remuneration had to be, and needs to still be, competitive to attract them. So that would be the main reasons, I'd say.
So I think you've identified two reasons, and we'll deal with the second one first. But the first reason you've identified is this move towards short-term financial considerations was aligning the interests of the employees with the interests of, or the performance of the employees with the interests of shareholders.
I put it another way, it was to align and incentivise particularly management, but then it trickled down towards more short-term shareholder outcomes.
And then the second point you made was that it was necessary and continues to be necessary in order to compete in the global talent pool.
Yes, yes, and domestically, but yes.
And so I just want to make sure we've understood that second point and the potential economic consequences of any changes in relation to remuneration. Is the issue one of absolute remuneration, or is the issue one of there is a certain type of potential employee who has a very strong interest in being able to earn variable remuneration depending upon their particular performance?
I think there's both. I've seen both. I think both are at play.
And in terms of the changes that your bank has made in response to Sedgwick, have they decreased your ability to compete in that global talent pool?
No, because Sedgwick really was squarely focused on the retail part of our bank. And I think as you go up, most of that talent pool is coming from within Australia, maybe New Zealand, Canada, UK, but I think mainly Australia. So Sedgwick, I think, was more the retail line, and that was more tellers and customer advisors and branch managers to get them more oriented in a different way. So it hasn't impacted our ability to get talent. And it was also done across Australia too. So.
And I'm sorry, what was done? Oh, you mean the changes
Sedgwick,
were made?
Yeah, so all the banks, have moved to do Sedgwick.
Right,
so it's evened it out.
So if we just sort of think through what that means economically, your point is at the level of tellers, home loan advisors, the frontline staff who are the ones affected by Sedgwick, most of that talent pool comes from within Australia.
Yes.
And
yes,
given that all of the banks have made or are making changes to try to reflect Sedgwick, there's therefore nobody suffers a first mover advantage.
Yeah.
But that there is another level of employee then, and I think you referred particularly to people with expertise in relation to technology and digital systems. I think you said robotics as well, who would be in a global talent pool.
Yeah.
And at that level, then you haven't made changes to how they're remunerated?
No, we have made some changes with these recent variable reward changes that we've made to the bank, and the nature of the 60% deferral at the top of the company and 40%, because I think that will be a general trend that we will continue with. And I think if you're going to be hiring people out of a global talent pool, which we need to do, you need to just be competitive in your financial package. I believe that most people actually, as long as you get that competitive, that financial package, people because of the other things I talked about. I really believe that, like the purpose and the vision and the culture and building for a long-term business and having pride in the badge and being stewards and doing that for the greater good of our customers and the country. I think most people come to work for those reasons. They're the intrinsic, deep motivators.
If you get the remuneration right to begin with, is that right?
Yes, but it just has to be competitive, is point one. So, you can't be, it's hard to hire somebody from a global talent pool if the basic pay is 50% less. I mean, they may love Australia, but that's a pretty big step. And I think it's got to be competitive in that sense. I think also this is where we go to this point around the type of variable pay, because I sort of think we need to keep pushing into it, but we still need it. But it should be much more balanced and much more long-term, and I think those sort of things are important. And it is important that people in a year who overachieve can have the chance to earn more than others who, have a solid year or perhaps less of a year. So I think it does give you a chance to discriminate. And I think that's an important thing. So if you're looking at people who do really well, you can pay them more for that year.
And just again to focus for a moment on the global talent pool, your point is if you defer 60% of the variable remuneration for 4 years, that doesn't put you so out of step with global peers as to be a problem for recruiting.
Not in principle. No, I think we need to do it anyway. So we should just do it.
So then, if we come back to the first reason that you gave for why there'd been this change over the course of the last, or in recent years, to banks moving towards short-term financial considerations, I think, as we've already discussed, profit itself might drive good or bad behaviours.
Yes.
And your point about saying that you need to be able to reward an employee who has an exceptional year is, I assume, touching on something, which is that the best way to motivate people, it turns out, is money.
No.
You don't think so?
No. No.
What do you think the best way to motivate somebody is?
Well, the best way to motivate people is to go back to what I said. Most people want to come and work in our bank or in a bank to serve customers, to do a good job for them, to feel as though they're making a difference to people in some of the biggest decisions they'll make in their lives. I mean, one of the most significant causes of stress is money. And so we have the skills to help people through that, to start a business, to grow a business, to buy their first home, to start saving for retirement. I think the people who I've dealt with in our bank and banks over many years, most people want to do that and do it well. Now, secondly, they need to live. So financial compensation is important. And if they do well, like an incentive payment, is a real act of recognition and appreciation. Now, Mr. Hodge, in our bank and in banking, I've seen some terrible cases of people who don't meet that rule. I'm not saying it's all like that. I'm just saying that's who we want to hire. And actually, in my experience, that's what most people want to do.
I think I'm concerned you think I'm trying to trap you when I'm just trying to get you to agree to what seems to me to be a very basic proposition about how a capitalist society works, which is that if you pay somebody more for a particular outcome, you expect that they will achieve that outcome.
Yes.
And therefore, variable remuneration is something that you've obviously found in your bank is an effective way to motivate people to achieve particular outcomes.
Yeah, so just on the basis of no trapping, I think the first thing is that we've had the wrong incentive schemes in many cases. We've had the wrong incentive schemes. We've take the introducer case. I'm sure you're coming to it. Like, that is like, we put the bait right there for people, right there. Now, they stepped over the line. That's their own decision. I'm not excusing that. But, like, we put incentive schemes in place which cause to reinforce and quick repeat cash. Not good. But now we've got a variable reward scheme where it's annual, it's centralised, it's based on achieving a number of things across 4 or 5 key result areas. It's deferred. It's deferred for the longer term for executives. It's starting to get more, sustainable. So that's the first point. The second point is, to me, it's more a recognition than a driver, right? It's like, if you get the people I was talking about, they'll do the right thing, they'll work hard, they'll want to do well for colleagues and for clients, they'll be proud to work in our bank because it does the right thing. And yes, at the end of the year, if they've done well, they could get an incentive payment, but it's not what's driving them through the year. So it's a difference between my motivation and hunger to do something that earns me that, and I'm sure some people are like that, as opposed to my job is to be a professional and to do those things I said. And if I do really well, I might get a variable reward payment at the end. Excellent.
I don't think we're disagreeing about anything. Your point is you can construct variable remuneration in a way that will incentivise bad behaviour.
Yes.
And that's not what you want to do.
Not at all.
And all I'm trying to suggest to you is the converse of that would seem to be you can construct variable remuneration in order to incentivise good behaviour.
And good. And I think we're doing that more so.
And that is what you want to try to do.
Yes, it is.
And when it comes to the idea of selling, from NAB's perspective, if a customer is sold a product that is useful to them and that the customer can afford, and that is within the risk appetite of NAB, then that's in the long-term interests of NAB.
Yes, it is. Although I'm just reacting to even the selling notion. So anyway, I'm agreeing.
I'm not. I just don't have another verb other than sell that I can offer you, Mr. Thorburn. I'm sorry.
Right.
But,
Okay. I'll think of one.
And that improves the profit of NAB.
Yes.
And does so in, from your perspective, a sustainable way.
Yes.
And therefore, if you can construct your variable remuneration to achieve that, that's a good outcome.
That is a good outcome.
And your point about the introducer case study is that, conversely, if you construct a remuneration structure which might have the potential to reward fraudulent conduct, that's a bad remuneration structure.
Yes.
And the issue then is trying to figure out the right way to do it, which presumably involves an element of judgment.
Yes.
And NAB, like the other banks as we've talked about, has made changes to its reward structure in response to the Sedgwick review.
Yes.
And Mr. Sedgwick expressed the view that, or considered incentives very closely as part of his independent review for the ABA.
Yes, he did. Yes.
And he recommended that for retail bank staff, including home lenders and their managers, incentives no longer be paid based directly or solely on sales performance.
Yes.
And he also recommended that retail bank culture will be demonstrably ethically and customer oriented.
Yes.
Do you think NAB has an ethically oriented culture?
Overwhelmingly, yes. Unfortunate cases where I'd have to say no.
And what do you understand by an ethically oriented culture?
That you would always do what is right by the law, by regulations, by disclosure requirements to the likes of the stock exchange, by way of transparency, and by way of doing what the policies inside the company require you to do. That's the first thing. And the second thing is that ethical must go to the heart of the relationship with your customer, so that you really understand what your client, what their situation is, you listen to them, you summarise it, and then you only give them products and services that meet their need. And sometimes you should say no, especially if it's a credit product, because maybe they're not in a position to be able to do it properly, even though they will think they may be able to. So I think they're the two strands I'd pull on ethical, Mr. Hodge.
And do you think it also has to affect the more general judgments that the senior executives make about things like remediation? That is, they have to approach these things in an ethical way.
Yep, that fits within my, I'm happy with that.
Would NAB ever consider moving to a fixed pay model with no variable component for its frontline staff?
For frontline staff?
Yes.
Only? You're talking about, as opposed to more generally?
Yes.
Well, I think we've, Sedgwick and the changes that have come in have been really good steps. I think we must continue to evolve it. I could see some argument for it, yes. I think most of the incentive potential for frontline people is quite small anyway, maybe 10 or 15% of their base pay. It's paid annually now, which is good. I would still be a bit worried if we did it. We'd have to think through the unintended consequences, but one of which would be, you've got really good bankers, and I think being able to recognise them with an incentive payment, let's say they're at 10% and you could give them 1.5 times of that, so they get 15%. I think that's a good thing if it's for the right bank, for the right reason in the terms of their performance over the whole year. So I would be a bit concerned that we may lose people to either other competitors, or if it was a level playing field, to non-bank competitors in financial services or other companies where their skills could be applied. So sorry, it's a long answer. Yes, I think is the answer. I think we should consider it, but I'm just calling out some things we'd have to think through if we pursued it.
And what about at the more senior level? Would it be practical to try to move to a purely fixed remuneration basis?
There I would accentuate the point about the risk of being able to retain and attract key people, particularly specialists, from within Australia and globally. I do think we should think about, are we getting some of these things right? The balanced scorecard, the deferral for 4 years. Maybe the percentage of variable pay, Mr. Hodge, could be reduced and more in fixed, so it's like a more fixed pay, less variable pay. But I would have some concerns about abolishing it, because I think it would make our sector, which is a very important one for Australia, less competitive. And I don't think we'd be able to retain and attract the talent we need to make our banking system really excellent.
Can I ask you about the change, or the Sedgwick changes and the anticipated potential adverse consequences? Was there a concern that it might be harder to motivate the top performing quartile of employees if they no longer could receive the same level of variable remuneration?
Well, no, it wasn't, because number one, I think we stepped into why we needed to make the change, and I think we had some very good reasons why we needed to make the change, and I think we communicated to them pretty well. And we had been progressively moving in this direction, so it wasn't like a new message. And the second thing is, because Sedgwick was commissioned by the ABA, and all the banks agreed to adopt it by 2020. Now, we've done it, as others have earlier. I think it enabled any sort of disadvantage commercially of not paying, having variable reward for some of your best people. They may go to other banks. They know it's not going to happen there either. So I think for those two reasons, I think we've been able to navigate it well.
I understand. I think I may have asked my question badly. You made changes to the way that to the way everybody was remunerated as a consequence of Cedric. Sorry, everybody within the front-facing system. There were presumably top-performing staff who were able to earn more under the old model compared to what they could earn under the new model.
I don't know that specifically, but I think what would have changed really, Mr. Hodge, is the frequency and the narrowness of the measure. So what they were paid for and how often has changed significantly under Sedgwick. So, but a top performer, let's say a banker in a branch, a top performer could still get a very good incentive, which I think would be quite competitive. It's just that it's done based on their whole performance for the whole year.
So I'm not here trying to get into the issue of competitiveness between banks. What I'm just trying to understand is the before and after. Under the old CXI model that you had, I had understood the internal NAB conclusion was that the CXI model tended to produce more exponential outcomes than what was the proposed future STI model that you've now implemented.
You might well be right.
And so all I'm trying to get at is has there been any issue for NAB with finding that its previous top performers are not performing as well as they used to as a consequence of the change to the remuneration model?
I haven't heard anything to that effect, Mr. Hodge.
All right. And then what I then want to understand is when we move over to this new system, or when you move fully into your new system of STIs, is how, from the employee's perspective, it will work. So I might just ask you some questions. This will no doubt demonstrate my ignorance, but I understand that now, for all employees who are within the STI model, the amount of STI they receive in a year is their STI target multiplied by an adjustment that depends upon the number of days they've worked across the entire year, multiplied by the performance adjustment less effectively a risk adjustment.
So the way I explain it is that we have a variable reward that's centrally managed and administered annually. It's based on rating people against their scorecard of these 4 or 5 KRAs. If they do have a variable reward, it is a percentage of their fixed pay. So that gives them a target potential variable reward. So if they were earning $100,000 and it was 50%, it would be $50,000 being their target. They may achieve somewhere between 0 and, I think if you're talking about the general population, 200% of that. If it's above 50,000, it needs to be deferred for a period of time. But their rating that they achieve goes through a process of not just a scorecard, and we do look at risk factors, yes. So we do look particularly at like senior people, the risk factors, and then whatever their potential payment is, it is multiplied by what we call the 1 NAB score, which is the overall multiple that the board determines for the year. So yeah, it is a bit confusing, but like that's how I explain it.
I think that's quite helpful. You've got an STI target, which is some percentage of whatever your fixed remuneration is. That's the starting point. Assuming you've worked a full year, then there's no adjustment for number of days. that gets multiplied by whatever your performance multiple is, which
Yes.
could be anywhere
Yes.
from 0
0
to 2.
Yes, that's right.
And then there's a deduction that is made for, termed it risk, but I think it's conduct gate
Yeah. Oh,
reductions is
yes.
how you refer to it.
Yes.
Is that right?
Yes.
And then there could also then be a multiple, which is the 1 NAB multiple, which is applied across everybody.
Yeah, that's right.
And the 1 NAB multiple is determined by the board.
That's right.
And I want to just come back then to the performance multiple and the conduct gate. The way in which your performance multiple is determined is by going to your balance, or seeing how you rate across your balance scorecard.
That's right.
And that tries to take into account, you said, a number of KRAs, is that right?
Yeah, key result areas or objectives. Yeah.
And the idea then is that you'll be rated across each of those 4 or 5 key result areas, and that will then produce your performance multiple.
Well, then the people leader needs to make a judgment, because they will say, are you achieved on this one, not achieved on the next, highly achieved, outstanding, and then they'll have to do a weighting to come out with what they believe is the most appropriate rating for you for the year. And that rating, obviously, if you get highly achieved or outstanding, you get a potentially higher incentive payment than if you got achieved. But there is judgment by people leader and people leaders in that process.
And so I'll bring up an example which I hope is somewhat helpful. If we bring up NAB.007.079.0006, we might need to zoom in slightly for that to be legible. Are you able to read that at all?
I think it's an iPad, and I'm trying to. It's not working.
Everyone does that.
I can't really see it, but let's give it a go. I can see some bits.
Well, I might see if I can get you a hard copy, because otherwise that's
If you take me to the bits I can see,
not going to be helpful.
Thank you.
Sure, that's going to help.
I just want to try to understand how an employee understands in the end that they're being rated.
Mm.
So this has a core role and a performance plan.
Yes.
And what is the difference between the core role and the performance plan?
Perhaps the way to think of it is that the core role is their basic role that they're required to fulfil, essentially maybe for their fixed pay, and the performance plan is more like a stretch. Similar measures and KPIs, but perhaps a bit more of a stretch where the incentive payment could come into play if it was achieved.
And so when we look at their core role has 7 different KPIs that are each allocated 14.29% for their role performance weighting.
Yes.
And then their performance plan has 4 different KPIs that are each allocated a 25% weighting in their STI.
Yes.
And a number of those are concerned with what's described as generating attractive returns.
Yeah, that's one of the KPIs. Yep.
And I think your point that you've made already about STIs is that it still has to take into account contribution to financial performance. That's still part of the role
Yes, it
of
is.
the employee.
Yes.
And then there's other things that are supposed to adjust for or take into account different considerations, things like improved customer advocacy, simpler and faster for our customers, proactively risk and compliance.
Yes.
And so all of these things will then get a rating as well.
Yes, so I think the first step is that the people leader would need to assess the banker on their core role,
Yes.
and then they look at the performance plan objectives to determine whether any incentive payment would be achieved with the weightings of 25% each.
And in the end, though, once they've got their full year outcome for each of their 4 KPIs, which will, for each of them, I understand they'll have a rating of 1 to 5, from not achieving expectation to outstanding achievement of expectation.
That's
Is that
right.
So then they'll have some number. Each number is a product of the exercise of some judgment. Is that right? By the supervisor.
Yeah,
And then the supervisor will at the end then make a further judgment as to how that rating translates into a performance multiplier.
that's right.
And I suppose what I wonder is, in the end, are employees going to find this to be a more or less transparent structure?
Than previously.
Yes.
Well, I think it's transparent, but I think we're on a journey on this one, Mr. Hodge, because it's complex, and I think we need to simplify it. But I think we're moving.
Is this the simplified version?
No, it needs to be simplified. So I think it's transparent. It reinforces an important message. I think this is a servicing banker. I think in our direct contact centre, it's really saying if you go to the KPIs, there are a number about customers and about risk you need to get right. And it's also about generating attractive returns, growth, but also done in the right way. And you are going to be rated, quite rigorously on all of those. So in that sense, it's brought rigour and discipline and broadened for the banker. So if the banker ever thought that my job is only to sell, I think this dispels that notion. Although, we're learning, we have to apply it in a more simple and effective way, I think. But we're getting one message through here.
Recalling that Sedgwick recommended that there be no direct link to sales as part of the variable remuneration for frontline bankers, does this still have a direct link?
You'd have to go to the generate attractive returns, probably at the top. These two are the first two look as though they're waiting times on calls. Mm-hmm. These bottom two are about customer needs. And see, it says based on 10 needs identified per team per week. So let's take customer needs identified. So that is talking to a customer, understanding their financial needs, and being able to identify them, and then satisfy them or refer them to a specialist if it's that sort of a need that the banker can't do themselves. So I think it does meet the Sedgwick criteria because previously it would have been probably about sales, and particularly when you get into home loan roles, about volume of sales, dollars, and I think that's where some of the problems occurred. So I think it does meet Sedgwick.
This no longer refers to dollar values or volumes. That's one of the points you're making.
That's right.
And I think certainly in the case of some of the performance plans, they will still be linked to things like lending referrals or what's described as home loan needs met.
Yes.
I'm assuming home loan needs met means the customer has taken out a home loan.
Yeah. And the other products and services they may need to help them achieve their goal of buying a home or buying an investment property, yes. But previously, I think it was a lot more related to the product growth and number of sales and the value of those sales.
Yes. And so it seems to me the point that you're trying to get at is, I don't want to use your expression that we're on a journey, but there is a a thought process that you are working through to try to figure out the best way to remunerate your staff to achieve the things that you want to achieve.
Yes.
And you'd like that to be simple and transparent,
Yes.
if it was possible. That's what you aim for.
Yes.
Realistically, does NAB have 4,000 staff at the moment? How many?
Well, we've got 33,000 in total, right? So you're going to have 10,000 bankers, and you'll have hundreds with this who are servicing bankers. Yeah, so there's a lot we need to do, and if we can automate it and simplify it, I think that will help.
How would you automate it?
Well, no paper. You know, we can just have a better HR systems which enable any employee, and we can do this now, look up on screen. Once they go through their ID, they can look on their own portal and see their scorecard. They can also see managers, you know, what we also have is discipline called something 11 plus 1, 11 conversations with your manager a year, plus one's the end of year to wrap it all together. You should be able to go into the HR portal and see your scorecard, see comments on progress from your manager, and points around your 11 one-on-ones that you've had. So that's automating it because it makes it real time, and you have less paper, and I think that helps.
Yes, I just wanted to be clear. When you said automated, that sounded potentially disturbing, but in the sense that there'd just be a computer or an algorithm that would determine what your employee's short-term incentive was going to be. But you're just talking about
I'm automating the process.
digitising it.
Digitising, yeah.
Yes.
Yeah.
And I attend to that document, Commissioner.
Financial year 19, direct consumer servicing banker performance plan, NAB 007079, 0006, Exhibit 7.82.
Thank you, Commissioner.
Mr. Thorburn, what message does the person who is the subject of this plan take away from it?
Well, Commissioner, I believe what the message they'll take away is that firstly, achieving in a number of areas is very important. Second, those areas, at least 50% of them are about the customer and their relationship and their engagement with us, not what we're selling them, to come back to that term. And thirdly, that the risk elements of a person's role must be very clear, and it is their own personal responsibility to understand them and to achieve them.
What behaviours do you regard this system as reinforcing?
Well, one of the things we say in our values, Commissioner, is to do the right thing. So the first thing is that you are really building a relationship with customers and you are listening to them in order that you can look after their needs better. Secondly, that growth is important, that you know, the bank growing through winning more business and doing more with clients, particularly existing clients, is important, that we need to have some element of a growth mindset in the organisation. And then the final behaviour is that risk is my responsibility. You know, the making sure that I disclose to the customer everything they need to know, that they know, you know, the interest rates and the fees, that if they're setting up an offset account, that I do that. And I think that the risk is not something that's about other people. The risk for a banker is about what they need to do in their role.
Yes.
Can I take an example, Mr. Thorburn, to try to work through an aspect of your answer? We talked about the idea that there would be a target for some of the roles when it comes to generating attractive returns for number of home loan needs met. And that's the type of target that you're familiar with.
Yes.
And so presumably if the employee manages to exceed whatever the target number of home loan needs met, then they'll be rated as exceptional.
They could be, yes.
And I think the point you're trying to drive at is that might sound like an encouragement to sell, but it's probably not really a problematic type of target.
Well, I think it could be in and of itself, but I think if you look at the broader scorecard and what they're being asked to look at and how they're measured, it minimises it. Secondly, and most importantly, it's how your leader coaches and talks to you about performance. You know, if they're only talking about how you're going on attractive returns, that's not good. They should be talking about how you're building advocacy with clients. Can I sit in and observe how you do that and give you feedback? Because I've done, you know, like I should be a coach. So I think the leader's behaviour, crucial, the most significant impact on culture in the bank. But I think we've minimised it, not just by those two things, but if you then look at previously the home lender would have been driven to and incentivised around, if I can do 5 loans at $500,000 each equals $2.5 million, bang. Now we've taken all that out. We've taken out the $2.5 million. We've just said you need to sit down, listen to your clients, and there'll be some needs come out of that. And I think that's an important part of the discovery process, to understand what the client's trying to do. And you do want certain needs to be picked up. You know, they may need a home loan and they'll go through a process. It could be a fixed rate, it could be a variable rate, it could be a split rate. And if it's fixed, how long it goes for, a transaction account, an offset account, a credit card. So I think that's what comes out of a home loan needs process that you want your bankers to be focused on.
And so I think, pick up 3 points that you're making about why this type of target is not a problem. The first is, this is not a target by itself, that the scorecard requires consideration of a number of other things, and what you're trying to do is make sure that you have a more holistic assessment of the employee's performance.
Yes.
The second point is, there is a cultural issue which you hope that your leaders will instill within your employees the right type of culture, or the right way to go about dealing with customers.
Yes.
And that's something you're working on.
Yes.
Always trying to develop and improve.
Yes.
And the third point is, this is a very different type of target from a target that is a pure dollar value target.
That's right.
And so, for example, when you think about this type of target, it's unlikely that a customer is wandering into a NAB branch thinking they're going to check their balance and then find themselves suddenly sold a home loan for a home they didn't even know they wanted. That's an unlikely outcome.
Yeah.
That's not the type of outcome that's being incentivised by this.
No.
What's being incentivised by this is that the customer wants a home loan. People come to banks because they want certain products, and the employee is actually trying to, they may not even need to identify that need, but they're trying to meet that need. That's the point of the type of...
Yes, and of course, under responsible lending guidelines, they've got to do that very thoroughly. Yeah.
I want to move then to the fourth point that you make in your letter, and that is about complexity. And you say that's the big change that's happened. I can bring that back up. It's POL.9100.0001.1010. And if we go to underscore 0003. And you'll see your fourth point, banks have become more complex in part due to increasing regulation, compliance obligations and legacy systems. Is part of the problem, do you think, that banks have moved away from their traditional roles of accepting deposits and lending money?
Well, I think that's added to the complexity.
Certainly in the case of NAB,
Yeah.
I think you would say many of the problems that you have had have been in your wealth division,
That's right.
and that's obviously a division outside of the traditional role of the bank. Yes?
Yes, it is.
And that's an area where there's been increasing regulation.
Yes.
There's been, or there are a lot of compliance obligations that
Yes.
NAB has found difficult at times,
Yes.
and where there are all sorts of legacy systems,
Yeah.
particularly in relation to how you collect money, retain money, pay commissions and that sort of thing.
Yes. Although I think it does. This point does apply to the banking as well.
Yes. I wonder whether, in your view, now with the benefit of hindsight, the move by retail banks into other areas, and particularly into wealth, has been a failure.
I think if you looked at the, raw evidence, probably have to agree it had been. I don't think it needed to be, but it probably has been.
And when you say you don't think it needed to be, why is that?
Well, firstly, I think for many customers, clients, when they come to particularly a large bank, say like NAB, they do believe that we would offer a broad range of banking and wealth management products. And when we sit down and talk to them about banking type needs, it easily moves into saving for retirement, protecting yourself against disability or unemployment, or protecting your family in the event of death if you have a mortgage. I don't think that's a natural conversation a banker would have. And so thinking of wealth management as something that's way out there, I think it's sort of just outside the banking circle. So that's the first point. It's a natural conversation, and I think many people would have seen that the banks do and could provide those sort of services. The second thing is, though, like in NAB's case, we bought MLC in, I think, around 2000. It's a long time ago. We're now in the process of divesting it, but it's a separate story. But what we did over those 18 years, I think we made some missteps, which caused us to be in the position where we're now divesting it. And that's why I say, when we started, I'm sure we thought it was going to be successful and we were going to integrate it and we were going to make it really core part of the bank platform, so that when you went on internet banking, you'd see your superannuation balances and if you had a share portfolio. But that didn't happen. So I would say it hasn't happened because there's more and more compliance and regulatory risk on the wealth side. We didn't probably understand that to the extent we did, should have. We didn't integrate MLC right into the bank. It was like a separate business unit, and it was more a standalone type business unit. And I think those things, and we didn't invest in it enough, to be honest. And that was partly for our reason. We had a couple of other strategic issues we were dealing with, which we decided to put money into, or had to put money into, particularly the UK, which probably took it away from putting it into something like MLC. So that's why I say it didn't need to be like that, but I think it's probably been like that.
Do you think that one of the issues might have been that the skills, experience and systems that banks have for managing the risks and obligations associated with accepting deposits and lending money have turned out to be very different from the types of skills, experience and systems required to properly manage the manufacture of wealth products and the provision of financial advice?
Yeah, I think they are different. Yes, I think we've had over say the last 10 years, which I'm a bit more familiar with in the NAB, we've had good expertise. We've had wealth experts, at the top level and various levels of general and executive general manager. So I don't think we lack that. I think it probably comes back to those other points. I think we could have integrated it and upgraded it and addressed its systems, and today we'd have a much more integrated and successful business that I'd be saying is going really well and helping our clients and helping shareholders. So I don't think it's so much about capability I think it's more about those other things I mentioned.
Finally, before we leave your letter to the Commissioner, you also say in that letter, on the first page of the letter, which is _0002, that you were initially not in favour of the establishment of a Royal Commission, but you were wrong.
Yeah.
And you say that the Royal Commission has provoked a critical self-examination and driven change for customers. I'm interested in understanding why you think it took a Royal Commission to provoke that kind of critical self-examination.
It's a good question. Well, because in my personal and professional experience, most transformation opportunities come out of pain. So it's like you are confronted. Sorry, Commissioner. No, not
spirit in which it's offered.
Sorry, not pain.
Equation has been drawn.
Yes, it has actually. So look, I mean, I've been a bank over 30 years, and I was in. Mr. Hodge, I referred to it, I think, in this letter or elsewhere as a drift. You know, like, and I'm sorry just to use this, but this is how I've explained it to our people. I've said, you know, I love fishing, and I drift fish, no anchor. And, you know, you start here, and after 20 minutes, you say, how did I get here? And it's the tide's taking you. And so I've been in this system, and I believe I have the right integrity and capabilities and skills, but I didn't see it. You know, I kept probably just defending it because I thought it was right. But when I saw the confronting stories, well, no, I'll go back half a step, back to the acceleration of our plan where we said we want to spend $1.5 billion more. I started to see that we need to simplify the bank, less products, upgrade systems, improve our talent, better compliance. I think I saw that, one. But two, the Commission, when you read the case studies, you say this is like so upsetting and so damning. What went wrong? And I remember one of the ones was the default interest one for one of our clients who was at the Commission. And I said to our team, why is it 18%? And there wasn't a really good answer to that. Why do we hit people so hard when they're in difficulty? And I just went back to the first 20 years of my career where that sort of wasn't the mindset we had, and it just got too complex, and we're not challenging enough. You know, people inside the bank are perhaps a bit passive, and we're reinforcing the current system, not because we want to, it's just that we're in the drift fishing boat. So I think what's happened this year is we've been confronted by some things we needed to be confronted by, and out of that is coming good change. And I believe will cause us to think about what is the purpose of the bank, and it's about earning your clients' trust and building a long-term sustainable business over 5 to 10 years. That's what we're getting back focused on.
Well, how do you make it last?
Yeah. Well, there's going to be a little bridge we have to go over, Commissioner. It'll take a little while because we're trying to change a whole cohort of behaviour and mindset and systems. But we've got to get back to some of the things we've talked about here. You know, one of the things I talk about more than most things to our leaders is why do we exist as a company, our purpose, our vision, our values, our behaviours. The second thing is we tried to dramatically simplify the bank. You know, we had, would you believe, up to 12 layers between me and the front line. I mean, now we're down to 94% as within 7. We'll get that to 100 next year. That's taking out a lot of middle management who are like observing things. No, they're not bad people. They're just, they're there to comply, not to change things. Reducing the number of products. We want to reduce our number of products by half. We want to reduce our systems by at least 25%. And then we're getting onto how are you measured? Go to your balance scorecard. It's not about selling and growth and revenue. It's about risk, and it's about customers and advocacy.
But it's also, as you said, about the immediate leader.
It is about the immediate leader.
The immediate supervisor.
Yes.
Dealing with
yes.
the particular person at
Yes.
whatever level
Yes.
in the organisation.
Yes, you're absolutely right.
Now, again, it may be wrestling a column of smoke, Mr. Thorburn, but how do you make it last? And we've got to the point of saying change is needed. You say you've got to the point of we are making change.
Yes. Yes.
I'm trying to look beyond that because I think that's what I'm required to do.
Yes, yes. Well, I was trying to answer it, Commissioner, by referring to some of those things, and then I was going to go on to measures and incentives, how people are measured and how they're rewarded. I think some of the questions Mr Hodge put to me about the very reward that we have and how we simplify the bank. I think if we could simplify our compliance and regulatory obligations, that would help as well. We need to automate a lot of these things, Commissioner, because at the moment they're manual in the bank and therefore they're prone to error. We need to invest a lot more in controls because controls should prevent and detect the problem, and we haven't had enough emphasis on that. But let me just try to land on this last point that you challenged me on, because you're right around, to me, the biggest driver of culture in an organisation, in my experience, has been leaders, the behaviour of leaders.
It's got to be.
The behaviour of leaders.
Yes.
So what we're doing is, we have, say, 3,000 people leaders. We are really going back to first principles with those leaders. We are explaining it is about character, not just performance. In fact, the way we define we want a leader, Commissioner, is by the term epic. E stands for empathy. The ability to relate to other people, to relate to colleagues, to relate to clients, to show you have a heart and emotion. P is to perform, I is to imagine, and C is to connect. So we're trying to go back to first principles. And a lot of that curriculum is being overhauled as we speak, and I'm the sponsor of it. I'm the personal sponsor of it. I think this could be the biggest impact I can have on the company, to build leaders who have those sort of capabilities, not just at the top level, but the top 1,000, the top 2,000 leaders. And I think we're investing a lot more in that. And we're measuring people on that. Things like employee engagement surveys and feedback to leaders. Recently we've sent out to leaders those from data, those we think are doing that well and those who are not. So I think this is the big challenge, and it said that some of the most important things can't get measured, and these sort of things we have to put some measures around. But in the sense it is a contact sport, and you really need to be coaching leaders and expecting more of them. So that's where I think we're spending more and more of our time, money, and effort, and that is the gold.
Perhaps to help you just further think through your answer to the Commissioner, if you just go back and think about the answer you gave about 5 or 6 minutes ago as to why you think it hadn't been possible to have this self-examination before the Royal Commission, I could pick out of that these ideas. The first, that there was a lack of challenge, that is, you hadn't been challenged in order to think about these things. And then the second, that there had been a lack of internal, perhaps, leadership and recognition of the problems. Do you agree those are two of the points you're trying to make?
Yeah, that's a good summary, yeah.
And it seems that in relation to the lack of challenge, that there were a few different issues with challenge. The first is, one way in which you might be challenged is externally by competitors. Mm-hmm. Do you agree?
Yes.
Now, the reality is there are 4 big banks in Australia, of which you are one. It's going to be very difficult to shift the competitive landscape in some way to alter the competitiveness and the challenge that will come from your major competitors. Do you agree?
We shouldn't be relying on that.
You shouldn't be relying on challenge from your competitors.
We've got to come back to our own vision, our own purpose,
sure,
our own standards, our own. So that should be driving us. Not, am I understanding what you're saying?
No, I think we're agreeing. Ultimately, you have to make the right decisions. Your point is that one of the reasons that you may not have made the right decisions or reflected on things adequately was the lack of challenge, and that's what the Royal Commission gave you.
Yeah, well, the Royal Commission has given us real cases of real customers where we've made terrible mistakes. And yeah, that's been an important part of the questioning of how did this happen.
And so if we follow that through logically, one way in which that challenge might have been introduced in the past and therefore might be introduced in the future would be by having an active regulator in relation to conduct matters that challenges you externally.
Yeah. Yes.
And it may be that improving the level of challenge coming from the conduct regulator to the bank would be a way of trying to make sure as an ongoing process that you're thinking through these issues.
Yeah, I think that's good.
And a second way in which this might happen, which is sort of a blurring of external and internal challenge, is that you have an ongoing supervision relationship with APRA.
Yes.
And APRA comes and looks at things and in theory would challenge you on a lot of these types of issues, these cultural issues, remuneration issues, decision-making issues that you're talking about.
Yes.
And so it may be that there needs to be an improvement or a change in the level of challenge that is coming from that, I'll say prudential regulator, but what we're really talking about there is the forward-looking regulator who is coming in and looking at what the internal outcomes are of the bank.
Yeah, I would agree with what you're saying. Although I think one of the things that we said in our draft APRA self-assessment, which I think you will have seen, is that we haven't listened to regulators enough. So it's like challenge is one thing, and I think that's useful, but we need to be in receive mode more. Now that depends a bit on the relationship. It's a bit more challenging with a conduct regulator than a prudential regulator, but I'm saying we need to lift the bar there. They should be helping us get better. We shouldn't be thinking of it as they're trying to catch us out.
But it's also related, is it not, to a point you made earlier. You spoke of the Commission raising real cases, in effect, publicly. Is that right?
Yes.
In fact, the real cases it raised publicly were cases within your organisation.
Yep.
That is, they were cases known to your organisation. What happened was that there was public scrutiny of the way in which the entity had reacted to those cases. What does that say about the need for different supervision and governance within the bank to recognise the reality and importance of the kinds of case that have been the object of public scrutiny and publicity?
Yeah, because we've got to get this right. We surely can't have this every year. We've got to build our own.
We all agree on that.
We've got to build our own muscle and strength, Commissioner. You're right. Let me just think about this. I think one of the things has been I want to go back to, in the last 5 years in the bank and banking, there's been good people with good intent, and even some of the things that we were trying to do sort of at the time sounded right, but we were sort of working off a technical grounding, not the spirit of what's right here for the customer. So if you come back to, not to use Mr. Hodges' words, but, the role of a bank is to have deposit accounts, lend money and make money. That's not the purpose of the company. That's what we do. Well, our purpose is to serve our clients, to build trust, to have trust with them. And anything that you're seeing inside the bank, complaints or problems, you should say, is this enhancing trust or breaching it or breaking it? And if it's not enhancing it, you've got to get onto it a lot quicker. So I think we've got to get our mindset back to why do we exist? What is our role? And it is to earn the trust of customers. And anything you're seeing inside the bank, both through controls that should pick it up and make sure it's not hidden. But I do think, come back to leaders, Commissioner, and why leaders believe they are playing a role in the bank, and that is to build trust with clients. And I think that will help flush these things out much more aggressively.
But does the significance of public exposure of these events mean that bad news has not filtered up the system in the bank towards the top of the bank where it has reached a level where an appropriate reaction can be had to the bad news story.
Well, I think it's that appropriate reaction and why that hasn't happened. Because I think, Commissioner, most of this bad news has been inside the bank. We've known. I've known. The board's known. Senior people. They were all known. It is our reaction to it. Now, if you think of this as, look, our job is to manage things and resolve this within the funding appetite we've got and subject to the profit and, like, if we can afford it. And, you know, if you take that line of thinking, equals wrong answer. Like, if you come back to our job is to earn the trust of our clients. And if we make mistakes, we should get onto that as the first priority as much as we can and fund that and put right capabilities and right remediation. I think that's the mindset shift we need to have inside the company.
Yes.
And it's, yeah.
Commissioner, is that a convenient time to take a break?
Yes, how long do you want, Mr.
I was going to
Hodge?
suggest a 15-minute break.
As long as 15?
I'll take 10 if that's the...
I'll go and consult the vendor at 10 then, Mr. Hodge. I'll come back at 10 to midday.
Thank you, Commissioner.
Yes, Mr. Hodge.
Thank you, Commissioner. Mr. Thorban, I want to turn briefly to customer remediation. NAB has recently established what it terms a customer remediation centre of excellence.
Yes.
And there was a study tour to the UK and conversations with the KPMG remediation centre that led to the establishment of your centre. Is that right?
I think it was around the same time, Mr. Hodge. I'm not sure it led to it, but yes, it was in the mix.
One of the things that NAB learned from its study tour was that remediation programs should be seen as an investment.
Yes. Yep.
Does NAB view remediation as an investment or as a distraction, do you think?
Oh, no. I think if you go back to my premise around our vision and purpose, earning trust of customers, when you've made mistakes for whatever reason and you know them, you've got to fix that in order to ensure that you have ongoing trust with the client. And not just with those clients, but with others who hear about it. So I think it's an important capability that we have that we will need for some time.
Do you think in the past that NAB has had a tendency to view remediation as a distraction?
I wouldn't say a distraction. I would say it's like one of the many tasks we have to do. It didn't have the priority that it should have. But I wouldn't say that we thought of it as a distraction, no.
And is the consequence of it not being thought of as a priority that, in your view, a lot of the remediation programs that NAB has undertaken have just been too slow?
Yes.
How does the Customer Remediation Centre of Excellence compare with Project Guardian, which was tasked to oversee fees for no service remediation?
So the Customer Remediation Centre of Excellence, I think, works off some principles. The first is that where you have material and complex cases, you do need capability and reporting to be able to elevate progress. And you need it to be centralised. You can't have it in the business, because the business will suffer from two things. The first is the many things they have to do, and that's legitimate. And secondly, they may not want to, in some cases, raise the problems. I hope that will happen less and less in the future, but or they'll be analysing it for too long, or going to legal agreements rather than really, what we all know should be the answer. So I think for those two reasons, we've centralised it, and I think that will make a far bigger positive impact on raising issues and getting them addressed quickly and money back in customers' hands if we've made mistakes.
Is it still the business itself that carries out the remediation, but it's supported by the Customer Remediation Centre of Excellence?
Yeah, I think because we're we're up and moving, and it's serious, but we're learning as we go through this. I think you do need to have local business ownership, because they know the clients, they know the products, they know the regulatory situation, know the capabilities they need, and also you want them to be accountable. Their clients, their mistakes, they should own it rather than just throw it over to someone else to fix it. But what you want in the Centre of Excellence is transparency of progress, metrics, our dashboard that throws up how progress is going. You also want them to do some leadership role in saying you need more, you haven't got the right sort of capability, so a challenge role. And you also want them to say, I actually think part of the reason they're going too slow is they just don't have the right resources, so we need to give them more money. So I think you need both. It can't be totally centralised or decentralised, and I think we've got a good balance at the moment. We'll just have to keep learning.
Can I just understand an aspect in relation to resourcing? NAB announced last year what it described as a transformation of the bank.
Yes.
And that's known as the Accelerated One NAB program.
Yes.
And that program involves significant cuts to employee numbers. Almost 6,000 employees, I think, will be let go.
I would say, Mr. Hodge, that is the outcome of us dramatically investing in the bank and dramatically simplifying. It means we'll need less of certain jobs in 3 years' time.
And is that likely, do you think, to come at a cost to compliance and remediation?
No, it should not. In fact, we're investing more the $1.5 billion I referred to over 3 years on top of the one. So that's $4.5 billion. And this year, I think from memory, we've got almost $500 million of the 1.5 we're spending is in what you'd call risk and compliance. So it's getting probably more investment than it has before, and it's needed.
I see. If we just come back to this idea of the Customer Remediation Centre of Excellence being a centralised unit but supporting the business, as we understand it, the centre is accountable for the remediation, but the business generally has oversight of the remediation. Is that an accurate description of how it works?
Maybe the centre has accountability for ensuring that all the major programs are identified, resourced, have clear timelines, and they are resourced properly to deliver as quickly as we can. Yeah, that's where I'd go to find that. But the business has responsibility for undertaking the activities in the time frame that we've agreed, because they're best to do it for the reasons I outlined earlier.
So is there a risk that the business would ultimately end up overriding the views of the centre, so that once again you end up in a situation where finance trumps compliance? Well, I mean, you're always going to have some tension in these sort of processes, but I don't think so, because the Centre of Excellence, it's very senior. It consolidates all the reporting. So in a sense, it has a very powerful and influential role. It can bring the facts to bear on any particular case. So I don't think the business would be able to trump it. It'd probably work the other way if the truth be known. But over time, we have to be careful that it doesn't go one way or the other, because the centralisation team, they probably don't have all the knowledge they need to make the right decisions either. Sometimes going too fast is the wrong thing. You need to get the data and the information right. So I think there's always a bit of tension, but I don't think at the moment, Mr. Hodge, that's a risk. The executive who is accountable for the Centre of Excellence is Sharon Cook. Is
That's
that
right.
Ms. Cook is the Group General Counsel.
She is the Chief Commercial and Legal Officer of the bank. So more than more than legal. It's a commercial role as well.
And so she has obligations under BEAR,
Yes.
including in relation to the Centre of Excellence.
That's right.
And when was the Centre of Excellence introduced?
During this year, maybe May, June, or thereabouts.
And have you noticed any improvement in how NAB is dealing with remediation as a consequence of the introduction of the centre?
Yeah, I have a lot more confidence because, there's 6 or 8 major programs under there, and what I'm seeing now is transparency of reporting and information and issues being raised. I mean, we're getting that. I'm getting a summary weekly. We can see it monthly in a more formal way. So I feel more confident now because there's less greyness and less place to hide. You can see exactly where things are at. And you're getting the business to give a view and the centre to give a view too if there is any disagreement, which there hasn't been, but you could see that occurring if it needed to.
We might come back to remediation when we deal with fees for no service. Just before we turn to that topic, I want to very briefly ask you some questions about the introducer program, not about the case study that was dealt with in round 1, but the introducer program more generally. I understand your view to be, from your witness statement, that you're satisfied that the introducer program is now fit for purpose, in effect, what you've brought into place.
Yeah, I wouldn't disagree with that. I have spent some time understanding not just how it happened, but what the controls and checks we've got and how we govern it and how we run it. I've met with a number of executives on more than one occasion to satisfy myself of that. Although, as I say in my witness statement, Mr. Hodge, I would say it's a under review, in inverted commas. Like, I think it's a watching brief, maybe is a more correct term, that I would like to just be really, really confident that, it is sustainable in its current form. But I feel comfortable that we've gone through some very sensible steps to this point.
And I'll try to summarise it as best I can, but your view as to the way the introducer program works now is that aside from some legacy sporting and community clubs, I think, that the introducers now will be people who have some sort of, their professional business is in some way associated or connected with the financing or the obtaining of a loan. Is that right?
That's right.
And so that would be people like conveyancers, solicitors, financial planners.
Yeah. Accountants, real estate agents.
Real estate
Yeah.
agents.
Yeah.
And those people, if they've signed up to the introducer program, would be paid some commission on when a loan is actually drawn down, and there's some qualifications
Yes.
on the time at which the calculation is made and things like that.
The essence of that's right.
And there's also some clawback provisions that you have in your agreements that relate to misconduct that occurs.
Yes.
And what I'm then trying to understand is, what is the benefit to a customer of this type of introducer program?
Well, I think what the customer gets is, if you like, an endorsement from the person they're dealing with, who they're already dealing with on financial matters, and there'll be most likely an element of relationship and trust that already exists there. And they are getting advised that if you go to see this banker at NAB, they are competent and they do a good job. They know what they're doing, they go through a good process, and I endorse them on that basis. So I think what the customer's getting is a potentially confident step that they can take to see a banker who does the right thing and is very knowledgeable, whereas otherwise they could spend a lot of time thinking about who do I go to and where do I start. I think that's the main benefit, as I see it, to the customer.
I have to say that seems like the main benefit to you rather than to the customer. That is, what you obtain is having one of these professionals effectively offer, either explicitly or implicitly, their endorsement to the customer of going to NAB. That's a benefit to you, isn't it?
As well.
So it's certainly, as a starting point, it's a benefit to you.
As well. Well, I think if you think of a customer, a person who's dealing with one of those professional groups and the sort of nature of what they're talking about, whether it's their small business accounts or it's a will or it's a planner who's looking at their financial situation and they're thinking about, okay, maybe I should get a different sort of a loan, maybe I should get a fixed rate, maybe I should buy an investment property, you know, and they're talking about those sort of things. So the customer's talking to their current advisor, and I think all the advisors then saying, look, if you do want to do that, if you go down to NAB, there's a banker down there called, and my experience has been they're very good at what they do. They are very thorough, they are very professional. So you could consider that as part of that step, because they might say, well, I'm not going to do that, I'm going to go to a broker or someone else, I know my neighbours does this, whatever. I think they, it's just really an opening of a door, and what they're relying on is the trust in the professional relationship they have with the person. So it's like anybody, two humans referring somebody to someone else. So I do feel, Mr. Hodge, it is a benefit to the customer for convenience and speed and confidence in seeing somebody who is endorsed by somebody that they respect.
If the advisor was just acting in accordance with their professional duties, going to make a genuine recommendation as to what the customer should do, why does NAB need to pay the advisor?
Well, I think there will be many where that happens, where there is no payment. I mean, I see, in my experience, been in banking a long time, it happens a lot. But where you've got a business who, the nature of what they do is financial matters, we have said it's important that it's sort of incidental or supplementary to it. It can't be a big part of their business. We still think it's a legitimate commercial transaction to pay the referrer. Now, you're pushing into some risks in this. I agree. That's part of the reason why I want to keep our finger on it, because it could be open to the wrong sort of behaviour. But I think we've really contained it to the moment, and we've got some better controls in place to prevent it from happening. So I think it's a legitimate commercial activity, but it does rely on, for example, that in that conversation that I referred to earlier, the advisor saying, and if that happened, I would be paid a fee. You know, so there's some transparency in that. So there's a little bit of operational risk already. But my answer to your question is, I think it happens a lot where there's no payment, but I don't think it's unreasonable that in some cases where you have a formal agreement that people can be paid for it, especially if they're seeing a lot of people and they're in the financial business.
Let's perhaps just take a few elements of that. As you've said, one of the things that the professional is required to do is to disclose the fact that they're going to receive the commission. They're required under your contract with them.
Yep.
You agree with that?
Yes.
But as I'm sure you know, and as the Commission published some research about this just before the commencement of Module 7, disclosure of that type of conflicted remuneration by professionals doesn't actually seem to have the type of effect you desire that it has, which is that a customer would become a client would become very suspicious of why the recommendation was being made.
Yeah.
You're aware of that?
Yeah.
This is just, as it turns out, what behavioural economics has shown us over the course of a number of years. And you've made the point that there are probably many cases where professionals make a recommendation to a client to go to a particular bank, to go to a particular person at a bank, and they're not receiving a payment.
Yes.
But of course, that is something that's totally outside of the introducer program. The introducer program, as you have simplified it down, is something where you pay professionals to at least implicitly endorse your products to their clients.
Yeah, I think it probably more endorse a person that they know, or it could be a group of people, yes. But of course, the process that then has to follow is that, where we didn't get this right in the Introduce It program, is the banker needs to see the client. And actually, so it's not, we're not necessarily approving it.
Sure, you've stripped out some of the elements that led to fraud and breach of the responsible lending obligations.
Right.
And what you seem to have simplified it down into is a program where you, and this is my word, which I suspect you'll disagree with, where you corrupt the professional relationship between an advisor and their client.
Yeah, I disagree with this.
With that word. And if it was the case, for example, that FOFA didn't have carve-outs for credit products, then it would seem to follow that it would not be possible for you to pay financial advisors to effectively endorse your product. Do you think that's right?
Yeah, I think so.
It would be a form of conflicted remuneration.
Yeah, as I understand it, yeah.
Right. I want to move then to another topic, and that is fees for no service. You've addressed some advisor service fees or fees for no service events in the statement that you've given.
Yes.
I'm going to ask you some questions about that, just so you know to begin with. What I'm going to exclude is anything to do with the plan service fees, which, as you know, is now the subject of federal court proceedings that have been brought by ASIC against your trustee, Newlis.
Yes.
So I'm not going. The questions I'm going to ask are just going to be about advisor service fees and some of the advisor service fee events. Now, you're familiar with those events. You've addressed them in your statement.
Yes.
And those events were the subject of significant breach reports to ASIC and APRA.
Yes.
One of the events was a NAB financial planning event, which involved the charging of advice fees by NAB financial planning to customers who were transferred to MLC Direct.
Yes.
And that meant the customer had no linked advisor when the fees were charged.
Yes, that's right.
And the fees were nevertheless retained by NAB financial planning,
Yes.
but there was no advice service provided.
Yes.
And the other event that you've discussed in your statement is concerned with the discovery that there were accounts of deceased members that had been charged service fees.
That's right.
And in your statement, you say that in around 60% of cases, there was advisor activity on the accounts following the death of the client, such as by assisting family members.
Yes.
But you agree even that wasn't actually authorised conduct.
Yes.
And in your statement, you offer some reasons for why you think the two events occurred.
Yes.
For the NAB financial planning event concerned with MLC Direct, you say there was a breakdown in a manual process by which clients were to be segmented when the advisor data required it.
Yes.
And you explain that due to data limitations, that did not always occur.
Yes. Yep.
Would it be helpful if
Yeah,
I
it would
brought
actually
up-
be helpful. Could I just
If we
see that?
bring this up, which is, if we bring up Mr. Thorburns' statement, it's paragraph 171, subparagraph C at page .0051. The witness statement is WIT.0001.0180.0001. Oh, and Mr.
Oh, it's
Thorburn,
in here?
yes,
Sorry.
one of your counsel is just pointing out you've got
Right.
a hard copy in front of you.
Okay. Could you just tell me the tab?
Paragraph
Oh.
171. It should be the very first document will be the actual witness statement.
yep,
and
got
it's
it, yep.
page 50.
171.
Page 50,
Yep,
paragraph
yep, no, I have it here.
171.
Yep, thanks.
And you see subparagraph
yep,
C,
okay.
as a result
Yep,
of the
yep.
limitations of the data in the
Yep.
segmentation report and the limited documented guidance in the segmentation report, the manual examination and assignment process did not always occur.
Yes, yes.
And as we've discussed, that then meant the clients were transferred to MLC Direct, which was the section that actually provided general advice rather than
Right.
personal advice.
That's right, yep.
And the fees were nevertheless retained. And presumably there was a point in time at which it was identified that this stream of revenue was coming into MLC Direct,
Yes, yep.
but nevertheless, NAB didn't stop charging the fees immediately when that was identified.
That's correct, yeah.
And in relation to deceased members, you say the conduct occurred as a consequence of a lack of process to reduce advisor service fees to zero after being notified of the member's death.
That's right.
And the issue was only identified after CBA or after the revelations about
Right.
CBA during the second round of hearings in the Royal Commission.
That's right.
Now, in the case of NAB financial planning and the retaining of fees by MLC Direct, the problem was not so much discovered as explored after customer complaints were received and an event was raised in NAB's event management policy.
Yes.
And so in both cases, it would seem something external prompted NAB to look at the issue.
Yep, I think that's right.
Why do you think that it took external events for NAB to discover these issues?
Well, I think it wasn't the intent that this would happen, but I do think the words you used previously, Mr. Hodge, that were in my witness statement, ineffective process design. I just don't think we set this up properly with proper processes and controls that would then identify much earlier that there was a problem. And also it was a design error and flaw. I don't think it was the intention to do that at all, but we didn't put it in place properly. So what we ended up relying on, which happens from time to time and is not entirely a bad thing, is you have a customer complaint and it then causes you to say, actually, maybe we should go back and follow the thread to make sure that this is not more commonplace. So ineffective process design, I would say, is the answer.
Somebody, though, must have made the decision within NAB that the process would be that when there was no linked advisor, the customer would be transferred to MLC Direct.
Yeah, you would think so.
Well, it must be the
Yeah,
case.
no,
isn't
that's yeah, because people were doing that manually. You're correct. But I don't know whether it was lack of training, lack of knowledge, as to why that wasn't picked up at the time, or whether it was because of as soon as you start to read things about segmentation reports, that indicates there's a lot of manual processes and data, and it just would have been one of those files that could have been so complex and operationally complex that the right level wasn't looking at it and the right capability. So I think it will be a human oversight as opposed to any intention that we see a problem here and we're not going to raise it.
The thing, though, that I think you're saying needed to be picked up wasn't that it was being done, it was that it shouldn't be being done.
The transfers?
Yes.
Yeah.
And do you agree with the proposition, or do you accept that to retain fees charged for a service when NAB did not provide that service is dishonest?
It's wrong. It's absolutely wrong. I think dishonesty goes sort of to intent, is the only distinction I draw, and I don't think I've seen this case and others, some exceptions, where there was an intention to not do the right thing, or maybe even, if you, as you're suggesting, an intention for it to be a problem from the start and someone to ignore it. I don't think that. So I think it was wrong that we didn't pick it up. And I think we got onto it reasonably quickly, but it was a process error. So I would say it was an unfortunate, it broke trust with our clients. And it took us too long to find it and fix it. So there's a problem for us. But the dishonesty would go to why, you know, the intent, and I don't feel it was dishonest in that respect.
And I just want to make sure, as best I can, I've understood what you think was or was not intended. It was certainly intended to transfer the client to MLC Direct.
Yes?
It was certainly intended to retain the fees.
Yes, although I don't think the people doing that knew that. I don't think they connected dots on this one.
Oh, I see. You think they didn't understand that by transferring the client to MLC Direct, they would be retaining the fees?
Well, they may, when you say it like that and you look at one client, of course, it's so obvious, but I just don't think that would have been what was happening at the time. They would have been doing bulk transfers. I think this was, and it would have been quite manual processes, and we may not have had the right capability. We certainly didn't have the right checks and balances in that process. I agree with that. But I'm just not sort of agreeing, Mr. Hodge, with your view that we knew what we were doing and that it was dishonest.
Let's just, as best we can, try to work it through. You knew that MLC Direct, this was known within the business, MLC Direct was not providing personal advice.
That's right.
And it was known within the business that these clients were had previously had an advisor and therefore were paying ongoing advice fees, and now they didn't have a linked advisor.
That's right.
And it was known within the business that the fees weren't being turned off because no one was turning the fees off.
Yes.
And it was known within the business that the clients were just being transferred over to MLC Direct to now be the advisor of record.
Yes.
Right. And is your point that, notwithstanding that all of those things were known, nevertheless, there wasn't a recognition that this was a dishonest thing to do? Or let me put it in a slightly more neutral term. I can see the challenge you have with the word dishonest. Is it your view that, notwithstanding that all of these things were known, there wasn't a recognition that what NAB was doing was wrong?
No, I think what I'm saying is that the first we knew this was an issue, i.e. we were doing something we should not have done, was when we had complaints. I don't believe, now I'm not agreeing that this is right, but I'm just saying that you've taken to 3 logic data points, and when you look at them you say, well, I can't disagree with that, but I don't think it was like, okay, we're going to transfer, we're going to not have advisors, we should turn it off. I don't think there was someone there sitting there thinking doing that. I think there was a big segmentation report. It'll have lots of people in it. It's a pick and drop into MLC. It's an operational error and oversight. Poor process design, then probably the wrong, not the right capability. That's where the mistake was made, Mr. Hodge. But it wasn't, let's do it and see if we can get away with it. I don't think that happened at all. So the first issue that pops up is we have a complaint, and then I think we've tried to act reasonably quickly after that.
Now, what's now happened is that you've introduced long-term controls, including automatically switching off ongoing fees. That's right?
Yes.
And there's also been what I think you termed detective controls have been introduced to try to identify if these events arise again.
Yes.
And when you, well, I'm sure you agree, these are, whilst they might be prudent, they're steps that are reactive to the fact that the events have already occurred. You agree?
Yes, I do.
And do you wonder why it is that those types of controls weren't put into place in the first place?
Yes.
And do you have an answer?
Well, I think some of which I've already said in earlier conversations with yourself and the Commissioner about this was a separate business. It was complex, it had legacy systems, it wasn't integrated into the bank. And I don't think one of the things we've been good at, Mr Hodge, in the bank or in NAB Wealth has been, controls. I think we're getting better, but I think at this time, go back to 2015, I think we weren't...
2015 is when it was
Yeah,
discovered.
yeah. The period prior to that, 12, was it? 12, yeah. So I just think this control piece and the automation of it, that's where we're trying to push into now, to have far more readily identified controls owned by the first and second line that are funded and automated. And I think, perhaps you want more discernment and challenge in the process. There would have been someone here who probably should have thought, hang on, let me raise this with my supervisor and people leader, because this is not what should be happening. So I think there's a range of, that's a cultural point, this last one. And then manual processes in complex systems with segmentation reports in Excel spreadsheets or whatever it was. I mean, that's a recipe for mistakes. So automating controls that are robust and tested more regularly, I think, are where we're going now. And that's a good thing.
Presumably another way of fixing the problem to stop it occurring in the first place would be to simply not have ongoing service fees.
Yeah, that would be a dramatic way to fix it.
Well, it may or may not be a dramatic way to fix it. It would be a way to fix it.
Yeah, well, we shouldn't, I mean, the problem here wasn't the fee, though. It was the fact that we didn't have proper controls around a group called MLC Direct that should not have, because it's a general advice service. It wasn't so much the fee itself. I mean, you could extend your logic into...
What do you mean by that, Mr Thorburn? It wasn't the fee itself. The fee was charged for something that wasn't done.
Yes.
Yes. What do you mean by it wasn't the fee itself?
Well, I think Mr Hodges' question was, well, you could solve this whole thing by just not having any fee at all.
Yes.
And I think having fees for certain services that you're clear with your client around and then are provided is a possible, very legitimate commercial activity that a bank could do. That wasn't the issue. The issue was we did not have sufficient controls in place to ensure that when the fee should have been turned off, it wasn't.
Well, let me put that proposition in other words. The other words are that this money fell into the pocket of NAB accidentally. Isn't that the proposition?
Well, I can't disagree with that, Commissioner. It wasn't intended to be ours, but it became ours. Yep.
Yes.
One of the reasons, or one of the fundamental issues is, isn't it, that the relationship between the fee and the service was so disconnected that it was possible that you would just keep charging fees without actually providing a service.
Could you say that again, Mr Hodge, please?
Well, if you think about it, if you provided a service and then after you provided the service, you invoiced the client for the particular service that you had provided, then this issue wouldn't occur.
Yeah.
That is, if financial planners effectively operated like every other professional.
Yeah, I can see why you say that.
And hence the reason why I wonder if you agree that financial advisors ought to be professionals?
Well, I think they are professional. In a sense, it's a matter of how you define what is a profession. I think there's been a lot of work done there's a number of many very good financial planners who have excellent accreditation and professional qualifications and take long-term views with their clients. I think it's gradually become professionalised. If you go back, 10 or 15 years ago, many came out of life insurance and was a commission system. I think we've come a long way since there, but clearly there needs to be further improvements.
In the past, financial advisors were effectively a distribution network for insurance or other financial products. Do you agree?
Yes.
And what's fundamentally changed, at least with FOFA, is that they're not supposed to be a distribution network anymore.
No.
They're supposed to be a professional, like an accountant or a lawyer as a professional, providing independent advice to a client.
Yes.
And those types of professionals, ordinarily, the way in which they operate is they provide a service. After they've provided a service, they charge for that service.
Yes. Yes.
They don't have ongoing fee agreements where every month some small percentage of somebody's assets gets debited and transferred over to the professional.
Well, that latter bit shouldn't be happening because it's a fee for service. It shouldn't be a commission like based on assets. But your broad point of a planner says that's the fee for service notion, that a client and a planner would agree a fee, and the fee would be paid by the client to the planner for certain activities. Now, I think we need to be clear on those activities, and I think I don't have a fundamental problem with why they wouldn't pay that fee on a monthly or quarterly basis.
Just so I make sure we've understood each other, there are financial planners who are still charging a fee for service, but a fee that is calculated by reference to a percentage of assets under management.
Yeah, that's grandfathered commissions.
I don't mean as grandfathered commission, right. That's just the basis upon which their fee is calculated. You know that?
Yeah, yes, but the move that we've led and are working on is that there is a much more transparent upfront fee that's agreed between the client and the planner. But my point was this invoicing piece that you were talking about. I don't see, if the fee is $12,000 a year, that could be paid $1,000 on a monthly basis.
After the service is provided,
Yeah.
You mean?
Well, maybe if it's an ongoing, if you're talking to your planner regularly, you may go a few months where nothing happens. You may have your annual or, twice a year consultation, but you may not talk to the planner for months, but you may talk to them a lot over a course. If you've got a particular transaction, you're getting a will done or you're setting up a new super fund or something like that. So this, I don't have a fundamental problem with they could pay as they go.
How many Australians do you think really need to be paying $1,000 a month for financial advice?
Well, obviously don't know the number, but I think that's a decision for individuals to make. A lot of people have investment properties, they have super funds, they require wills, they may inherit some money. And I think all those lead to a situation where you could have a planner where there's an ongoing fee charged of that amount and an ongoing relationship, because if the planner's doing their job, they're really helping you, not just with those things, but things like tax. So I think that's a question for individuals, depending on the complexity and their circumstances.
The problem, though, as we've discovered, is that often certainly in some cases, the financial advisor isn't providing the service, and nevertheless the fee is being charged. You agree?
Yes.
And that's an industry-wide problem.
Yes.
And it's a problem that you would think has its roots in the fact that traditionally you got paid a commission because you were part of a distribution network and you didn't have to provide a service, and now it's been rebranded as a fee for service, but you're still not providing a service. You agree?
Yeah, I can see why you say that. I think there's been various evolutions, and I think the last one came when FOFA came in. So yeah, I think you're right. There's people transitioning in mindset. I think a lot have progressed very well, and there's some that haven't, and that's not a good thing.
And in addition to the two events that we've talked about, the MLC direct event and the fees charged to deceased estates, there is this broader issue across both NAB financial planning and also your licensees, where fees have been charged by the advisors but the services haven't been provided.
That's right.
And at the moment, you still don't know the extent of this issue within either NAB financial planning or your advice licensees.
I think we're more and more confident around the NAB FP side, Mr. Hodge, the aligned advisors. I agree with your proposition there.
In relation to NAB FP, you've agreed on a review and remediation program with ASIC.
Yes, we have.
And under that program, you'll be going back and testing for all of your ongoing service agreements, whether or not the services were provided to justify the retaining of the fees.
Yes, although the first 33,000 of the 80,000 odd that we're looking at, we're not really doing that. We're just paying the fee back. And that will be done over the course of the next few months.
And is that 33,000 because you don't have records of engagement between the financial advisor and the client, or because it's not cost effective to review whatever the arrangements, whatever the records are?
I think it's probably both.
And I think what you've agreed with already is that if a financial advisor retains fees when he or she has not provided the services that were to be provided for those fees, that is dishonest?
Well, only if they know.
I understand.
If they know,
Yes.
and they don't do anything about it, dishonest.
Yes. We're talking about something slightly different.
Right,
I
sorry.
understand the point
It's
you're
the
making.
word
which
that's
is-
getting me.
Yes, when we were talking about dishonesty before, I
Yeah.
thought that your objection was to it being applied to a situation like the MLC direct situation or the deceased estates situation, because you thought nobody may have intended that result. That
Yes.
was the point you were making.
Yes,
If a financial advisor
right.
charges fees to a client and they haven't provided the service, but they retain the fees, do you think that's dishonest?
Do they know?
So it's if they consciously know they're not providing the service, then it's dishonest.
Yeah, that's,
All right.
yeah, yep.
And what about if they just don't care whether they're providing the service?
They don't care.
That's right, they're indifferent to it in the sense
Right.
that they have no system for checking whether or not they provided the service.
Well, that's not dishonesty. That's just professional negligence.
I see. And do you think that at a minimum, if a bank like NAB owns an advice business and has authorised representatives operating under licensees that it owns, that it ought to have sufficient systems to prevent dishonesty, that is, dishonesty of a financial advisor retaining fees without providing the service and knowing they haven't provided the service?
It was going so well that the word came back. Dishonest. So I just want to try to answer it, Mr. Hodge, by saying the licensee is required to do certain things. The advisor is required to do certain things, and they're sort of two separate things because they're two different functions. And so it depends on, where the primary fault is. Is it we don't have systems to be able to identify the fee that's being charged for what? And I think we do have some complications in our fee and commission systems. Or is it the planner themselves who's not fulfilling what they should do as per their ongoing service agreements? Now, if they're doing that, if they're not caring about that, that's the professional negligence I talked about. But I don't believe, even in this broad case, it was dishonesty.
The advice licensees, or the four advice licensees that NAB owns, they ordinarily deduct the fees from the members, is that right?
Yep.
And then they will remit,
Yep.
presumably some amount, some proportion of those fees back to the advisors. I think that's the way it works, yeah. And one of the problems that NAB has now in relation to its advice licensees is that they have inadequate records to be able to determine whether or not the services were actually provided.
For the advice licensees?
Yes.
I think that's one of the issues, yes. I think we're going to be working through that now to find how big that problem is. I don't think it's the only issue we're dealing with in this case, but I think that's a fair proposition.
And it's, to be fair, not just an issue for your bank, it's an issue for other banks and AMP as well, that they don't keep or haven't kept records of whether advice or service was provided by the authorised representatives.
Yes.
And on its face, one explanation for that would seem to be because, to just take NAB, you weren't interested in whether the services or advice was provided.
Yeah, I don't agree with what you're saying, but
That's I'm not saying that's
sorry.
the explanation, but
Yeah.
that's one
Yeah.
reason
Yeah.
why it might have happened is because you just didn't care.
Yeah.
You agree?
that's potential. Yeah.
And is there another potential explanation that you can think of?
Well, I think when we started this, we wanted to move to a more transparent fee for service for clients so that they could choose that. I think we implemented that poorly, Mr. Hodge. I don't think we had proper controls. We didn't digitise files. We didn't fully track the advice that was being given. And there was a lot of change, and still is, between commissions and fees, and in the case of aligned planners, not just MLC products, but other products. So it's a more complex case and platform. And I think that's probably the other reason, a combination of not digitising, not tracking and reporting, and multiple platforms with commissions and other people's products in there. I think those are the other three reasons that I would offer.
Those reasons don't really seem to be reasons. They seem to be the things that happened. That is, you didn't digitise them, you didn't keep records of advice, you were operating multiple different systems and platforms for the payment of grandfathered commissions and ongoing service fees. I'm interested in understanding why you think those were the things that happened. And I've suggested to you one possible explanation, which you've agreed is one possible explanation. I'm interested in whether you think there's another possible explanation.
Well, not apart from what I said, I'm sorry, because I see those as things that happened that if they hadn't have, the issue would have been arisen a lot faster and we could have dealt with it far better. I think the only other reason I can think of, could you just ask your question again, Mr. Hodge, just so I see if I can be precise.
Can you think of another reason why it is that you didn't keep adequate records
Right.
of the provision of the advice.
Well, then I know those are the reasons I would. That's my best answer.
I want to move then to another topic which is related to this, which is how you've gone about handling the remediation of the ASFs. And I think you agree that it has taken too long.
I do.
And the timeline as we understand it is that ASIC had made an initial request for NAB to review all of its licensees and NAB financial planning for ongoing service fee issues in June of 2015.
Yes.
And over time, NAB has put forward various proposals to ASIC as to how it might go about doing that.
Yes.
And one proposal that was put forward at the end of 2016 was that there be a review and the advisor would be required to point to an offer of service.
Yes.
And ASIC rejected that proposal.
Yes.
And the second proposal put forward in about December of 2016 was that NAB would assess whether there had been a fair exchange of value.
Yes.
And ASIC rejected that proposal.
Yes.
And ASIC said that it would like NAB to be able to supply direct evidence that each service outlined in the ongoing service plan agreement was provided every year for every customer that was charged.
Yes.
And a third proposal was presented by NAB in July 2017, which was, I think, loosely termed or referred to as the ongoing service principle. You're aware of that?
Not so
At
familiar
least
with that.
there was a proposal put forward in about mid-2017 that still wasn't in accordance with what ASIC wanted.
Yep.
And then in October of 2017, ASIC sent NAB an outline of suspected offending.
Mm-hmm. Yes.
Did you read the outline at that time?
Yes, I did. Yes.
And did you form a view at the time as to what NAB should do?
Yeah, differently. Differently, you mean?
Yes.
Yeah. Well, no, I think it was. It probably wasn't the spark of change that it should have been, Mr. Hodge, in hindsight. And there was a lot of correspondence from ASIC and other regulators, and so I think we should have used that as more of a. We should change tack here, and I don't think we did enough.
What happened once ASIC effectively put forward this outline of suspected offending was that it was then treated as now having a legal issue involved?
I don't. I think one of the issues probably in hindsight is we maybe didn't have enough legal resources involved beforehand. I don't know whether it escalated particularly after that letter.
Was it the outline of suspected offending that was the trigger for Ms. Cook being asked to step in and become involved?
What was the date of that? Was it October 17?
Yes.
Yeah, it could have been. Yep.
And
I just can't recall the detail, but it's logical.
well, and then and maybe to help orient you, can we bring up ASIC.0039.0003.0543? So this is a letter sent by ASIC to Ms. Cook on the 3rd of November 2017.
Yes.
And you'll see what's said in the first paragraph after Dear Ms. Cook. I understand from your conversation today with Tim Mullally that you have recently assumed responsibility for NAB's discussions with ASIC regarding NAB's fees for no service and related matters. Does that help you at all to just fit together the timeline as to
Yeah,
when?
that does help. Yeah.
All right. And so at that point then, was the situation that Ms. Cook was responsible as the senior executive for dealing with ASIC, but Mr. Haggar continued to have a business responsibility in relation to the remediation program?
No, my understanding was I wanted Sharon Cook to be more involved because she was, one of her roles as Chief Legal Counsel. She was relatively new to the bank, and I just thought that combination of the outside in and the legal expertise would bring more sharpness to it. But this had been going on for quite a long time, and it had been led by the NAB Wealth business all the way through, and I think that's appropriate. And so I still saw the NAB Wealth business, particularly Andrew Haggar, as having the primary lead on it.
But not the lead for the discussions with ASIC.
Yeah, I think the way that worked in practice, though, was it probably still did continue like that. So I can, this between here and April, there was, I think in hindsight I should have given it more clarity, but the way it worked in practice was it was still led by the business, and Sharon Cook, if you like, was the challenger and the legal expertise on it to see if we could bring it to a head quicker.
Now, this letter, or one of the things that this letter says, is that NAB's approach to remediation is out of step with some of its major peers that have reported fees for no service failures and are close to finalising their customer review and remediation programs for these failures.
Yes.
And did you see this letter at the time it came in?
I think I would have, yes.
Were you aware that NAB's approach was out of step with its major peers?
I wasn't, Mr. Hodge. I wasn't aware of the detail of it. I mean, I wish I'd got a bit more involved to get on top of this quicker. But I delegated this, and it was one of the many things that we were working through. And so I didn't really if it came out to me in the letter, I didn't interrogate it to say who and why and how and what should we do. I didn't do that.
You recall the question I asked you earlier this morning about NAB having a culture of being ethical?
Yes.
When you reflect on the fact that the other banks were remediating these fees for no service issues in a way acceptable to ASIC, but NAB was not, does that tell you anything about NAB's culture of ethicality?
I don't feel you can draw that conclusion and that link between the two, because I don't think we were wanting to be unethical, or we were being unethical in our dealings here. So I don't think, and also to flip it the other way, I'm not sure our competitors were being more ethical because they'd managed to conclude their fees for no service program.
I see. And then, Commissioner, we don't need to tender that letter. That's already gone into evidence in round 5. And then if we skip forward about 5 months, in a letter dated 13 April 2018, Ms. Cook made a further proposal to ASIC in relation to remediation. You're aware of that?
Yes, I am.
And we can bring that up. That's asic.0039.0001.1727. We just go over the page, we should see the letter. I'm sorry, 2 pages. Now, the Commission asked you a number of questions about that letter, which you answered in your witness statement. And perhaps just given the time, I'll just ask you some general questions for the moment. Do you think, obviously now with the benefit of hindsight, that that letter should have been sent?
No.
And I take it follows from that you think that the proposal that was put forward in that letter is not acceptable
That's correct.
and is not consistent with the values or purpose or vision that you have for NAB.
Yep, that's correct.
And the particular issue is in relation to how pre-FOFA clients were to be dealt with.
That's right.
I think you probably don't have any concern with how post-FOFA clients were to be dealt with, and in fact ASIC, effectively that is the methodology that's being used now.
It is, yes.
So the issue with pre-FOFA clients was that rather than reviewing whether or not you had actually provided a service to them, they would have to come to you and after your invitation and attest to you that they had not received a service.
That's right.
And then there would be further steps that you would check to see whether you had some evidence that the service had been provided.
That's right.
And the justification, or a justification that was offered for this, was that NAB had moved early moved early away from pure commissions to ongoing fee agreements.
That's right.
And your view that you explain in your witness statement is that you don't think that that was an appropriate justification.
That's right.
And have you always held the view that that was not an appropriate justification?
No, I haven't. Well, it's been since that letter and what's transpired that's caused me to look at it and go back through the history to try to understand what we were doing and why we were doing it. But to answer your question, Mr. Hodge, I at that time, I didn't have a particular different view. I delegated it and I had left it at that. But now I go back and look at it, and as I've said in my witness statement, I think the pre-FOFA piece was not a justifiable argument.
Well, you were aware of it at the time that was the justification, weren't you?
Yeah. No. Well, if you go to the letter, yes.
I'm sorry. What do you mean? You mean if you look at the letter?
Look at the letter, yeah.
And you looked at the letter at the time, or you're not sure?
Well, no, I'm not sure whether I saw it before I went, but I can tell you I'm accountable for it.
What do you mean by that? That you're accountable?
Well, I'm the CEO of the company, and that's gone under our letterhead.
Oh, I see. Can I show you a document? Can we bring up NAB.006.041.0387? Sorry, _E. So these are the minutes of a meeting of the NAB Board Risk Committee.
Yes.
And you'll see they're the minutes of a meeting on the 30th of April 2018.
Yes.
And you were present.
Yes, I was.
And Mr. Is it Gall or Gal? Gall?
A Gall, yes.
The Group Chief Risk Officer was present.
Yes.
Mr. Hagger was not at the meeting.
That's correct.
And he never joined the meeting, so far as we can tell.
Yep.
Ms. Cook joined the meeting. If we go to page 3 of the document, we see at the bottom of the page, just before 55-2018, Ms. Cook joined the meeting.
Yes, I see that.
And this was concerned with advisor service fees.
Yes.
And there was a paper that Ms. Cook presented on as to the status of ASIC's investigation into the fees for no service issue.
Yes.
And we may need to look at that paper after lunch, but if we just go over the page, you see there's a reference to the fact that there was a proposal submitted on 13 April 2018.
Yeah.
And then what's recorded in the minutes is management remained of the view that its industry-leading position in moving away early from commission-based remuneration for advisors prior to implementation of the FOFA reforms should be taken into consideration when compared to peers.
Yes.
And it would seem then that this particular justification that you, I think, regard now as inappropriate was something that was specifically brought to the attention of the Board Risk Committee, on which you were present on the 30th of April 2018.
Yes.
And I take it you don't recall any challenge to that proposition?
No, I don't recall, Mr. Hodge. No.
And it didn't strike you at the time that the position was unacceptable?
Well, something had happened in between the two, between the 13th of April and the 30th, where a movement was changing. Would you like me to say what that was?
Yes.
I met with Mr. Shipton, ASIC Commissioner, my first meeting with him, and on the 26th of April. And he made it very clear to me that things in this respect were not good, and that they had been very disappointed with the legal, technical way that we had we had been dealing with this matter. And that was important for me, because it was the first time I met him, and I remember the conversation covered a number of aspects, but I remember this one. And again, I walked out thinking, we've got to do something to change the course here, because that's not the reputation we want. So whatever we're doing, it's not working. And I remember talking to Sharon Cook after that meeting. And so it may have been prior to this meeting or just around it, to say that I wanted her to take sole primary responsibility to conclude this matter with ASIC. And so, whereas the business had been leading it, that I wanted to be very clear unequivocally that I wanted her to take it forward and conclude it as quickly as possible.
Is that a convenient time, Commissioner?
Yes, 2 p.m.
Thank you.
Can you be back at 2 p.m, please, Mr.
Commissioner,
Thorburn?
yep.
Yes, Mr. Hodge.
Thank you, Commissioner. Mr. Thorburn, before lunch, we'd been looking at the minutes of a meeting of the Board Risk Committee of the 30th of April 2018. I might just tender that at this point, Commissioner.
Minutes of NAB Board Risk Committee 30 April 18, NAB 0060410387, Exhibit 7.83.
Thank you, Commissioner. Now, Mr. Thorburn, I want to ask you some questions about what you've said in your statement about this letter. So we might bring that up. Can we bring up page 64 of Mr. Thorburn's statement and begin with paragraph 219? If we go to the next page where paragraph 219 is. And so in answering the Commission's questions, you said that you'd reviewed this letter from NAB to ASIC dated the 13th of April 2018, and you've discussed it with both Ms. Cook and Mr. Hagger.
Yes, that's right.
And when did you discuss it with Mr. Hagger?
Well, in particular, leading up to my witness statement, that's in particular. Yep.
So this is after Mr. Hagger had left the bank, is that right?
No, it would have been before Mr. Hodge. It would have been prior to 1 October. I think I would have had the discussion with him. He was still in the bank.
What was the date that Mr. Hagger departed?
Well, I think we did a handover from 1 October with the new leaders, but he didn't leave until 14 November.
All right. The witness statement that you've prepared, you were sent the rubric on the 16th of November 2018?
Yeah, I can't recall the exact date.
Oh, I'm sorry.
Sorry, I thought
that
it
might
was
be the date of your statement.
right.
Your statement was the 16th of November 2018.
My witness statement?
Your draft,
Yes.
the draft
Yes.
statement. And I think you had the rubric for about a week
Yep.
before, or
Yep.
a bit longer. And that would have been in early November then that you received the rubric.
Yeah, that's probably right. Yes.
But you discussed this issue as to who had management responsibility, did you say before the 1st of
So
October?
was your question the letter of 13 April? When
Yes.
did I discuss that with Mr. Hagger?
Yes.
Well, you recall, as I said, that I asked Sharon Cook to take the lead role to resolve this with ASIC. And I think I had conversation with Andrew Hagger at that time about why I wanted it to happen. I think there was a letter from ASIC dated 9 May that came in. And so, look, that was in our conversation about they clearly were not happy and we needed to resolve it. And then I really thought about the letter, Mr. Hodge, in the context of the rubric when I was asked to reflect on what did I think of the letter. And I suppose I just thought about it a lot then when I read it a few more times, and I thought about what happened since and why it took so long and the tone of the letter and things like that.
And so the thinking you did about the letter was predominantly done after you received the rubric?
Yes, yes.
But the discussions that you had with Ms. Cook and Mr. Hagger about the letter, they occurred earlier?
Yeah, that's right. And I actually think it was less about the letter, Mr. Hodge, it was more about let's get this resolved.
I see. And you say in your statement that Mr. Hagger was the person who had management responsibility for this issue at the time the letter was sent?
Yes.
And management responsibility means what in this context?
In this context here, 219, if we go back to Mr. Hagger had management responsibility for this matter in a business sense, ASF, fees for no service. He had a lot of the contact and with Mr. Kell and others. And so I saw him as the person who was still carrying forward this issue in a management sense. Sharon Cook was clearly involved, but if you like, in that period up until the end of April, she was secondary, if you were to call it that, if I could call it that, in the matter.
She had the primary responsibility, though, for dealing with ASIC.
Yeah, but that's where I said before lunch, you read that letter and the minutes and that's what it said. But I was saying in practice between November and April, Andrew Hagger really was the person dealing with ASIC on the matter. And that's why I said I could have made that a bit clearer to my people who I wanted to, resolve it. Because Mr. Hagger carried the responsibility in practice.
I see. And you have asked Ms. Cook about what her involvement was?
Yes.
And I think you did that in an email?
I did that in an email. Yeah.
Oh, I'm sorry, you might have asked her orally and then
yes, I
she
did.
sent you an email.
Yes.
If we bring that up, that's NAB.186.012.4999. So you asked her sometime before the 7th of September
Yep.
about her role?
Yep.
And
Yep.
this is her short note of
Yep.
her role in the ASF negotiations.
That's right.
And her simple point, as she says, is that she did not assume either responsibility for or accountability of our negotiations until after we received the cranky letter from ASIC dated 9 May 2018. And you've accepted that?
I accept the essence of that, yes. Yes, I do, Mr Hodge.
And I'm just trying to understand, in your own mind, how does that fit with the fact that since November of 2017, the correspondence that has been occurring between people from ASIC and Ms Cook
Yeah.
from NAB, and that also, just so you can have all of these things in your mind, that it's Ms Cook who is presenting or sponsoring the management paper that's coming to the Board Risk Committee about the negotiations for the Board Risk Committee's meeting on the 30th of April 2018, and that it's Ms Cook who is appearing at the Board Risk Committee meeting and presenting on the issue, and that Mr Hagger is nowhere in sight.
So clearly the two of them were both important leaders in this resolution and taking it forward and probably dealing with ASIC. But as I saw it, Andrew Hagger had the primary responsibility for dealing with ASIC on it, Mr Hodge, like the conversations that were happening. He had relationships with particularly Mr Kell, and so often there would be a conversation there about this matter, because I think Andrew was trying to move it to a conclusion, and he was talking with Mr Kell about that from time to time. I don't think Sharon Cook was doing that. So Sharon may have had a more, official contact with ASIC and would be the subject of official letters. But in terms of, and whilst they work together, in terms of calling the shot, if I may say, like about what should we do, and is this pre-FOFA piece possible, and on what basis would we feel it's possible? That was based on a conversation that Andrew had with Peter Kell, and he felt that that was possible. So that's how I'd explain it. The two were working together. They were both in the mix here. Sharon was the official person with ASIC, and that's where the letters were going to, but really the management responsibility for saying how could we conclude this and on what terms, that was mainly done by Andrew Hagger.
And this was known to you in April of 2018, wasn't it?
Was it known to me? I suppose I saw it, that's the way it was working in practice. Yes. And Mr Hagger had primary carriage of it for some time, and I had delegated that to him, had confidence in him. He was, I feel, had the right intent to try to get to a conclusion. So that had, he was mainly the person who would speak to it about what might be possible or not. He was so it was known to me in that sense. Now, if I had stood back for it, I would have said, hang on, let's just be clear here. Who's the one person I'm holding accountable for resolution? And that was probably in hindsight my error, because I should have made it much clearer. Although Andrew Hagger carrying it was probably sensible in the sense that he had a lot of the relationship and contact and history on the matter.
So Mr Hagger was the one who would speak to it as at April 2018?
Well, if you go back, certainly at our management meetings, when we have our executive committee meetings, Andrew would be, because he had the working knowledge of it, and he was in the business, he knew the detail, he knew the history, so he would speak to it in that respect. You are calling out one particular point where he wasn't there. Often he would be, so I'm not sure that was for a particular exclusion reason. That 30 April one, Mr Hodge, but in a day-to-day sense, he would be speaking to it and probably be the best informed to know where the discussions were with ASIC.
But the paper that was presented, perhaps we'll bring that up. So if we go to NAB.006.023.0062, I'm sorry, Commissioner, I tender that email.
The email of September 18, Cook to Thorburn. NAB 1860124 treble 9, Exhibit 7.84.
So this is the memorandum that was prepared for the Board Risk Committee leading up to that meeting of the 13th of April 2018.
Yes.
And you can see just in the bottom right corner that it's what we've seen already. It's for agenda item 6, the Board Risk Committee. You can see it's page 62 of 170 for the committee pack. And this is the memorandum or the paper providing an update on the ASIC investigation into fees for no service.
That's right, yes.
And then if we go to the second page, we see it's summarising what's happened, and it said, since receiving the legal opinion, NAB has continued to work on the proposed ASF review methodology. NAB sent to ASIC its proposed ASF further review methodology and the proposal in relation to the regulatory response to the ASF breaches on 13 April 2018.
Yep.
And then you see at the end of the document where it has proposed by, it's somebody from Dispute Resolution and Regulatory Investigations. And the person who supports it is Ms. Cook, the Chief Legal and Commercial Counsel. And it's the person who supports it is a paper of this type is the senior executive who's responsible for it. Is that right?
Yep, yes it is.
And it's, again, I think what I'm struggling with is, as you recall it now, you think it was Mr. Hagger who was actually responsible for determining what the methodology was and driving that. But Mr. Hagger wasn't reporting to the Board Risk Committee, it was Ms. Cook, is that right?
Yep, that's right.
And that it was, I think what you're saying is you're attempting to sort of take the criticism upon yourself to say it was just unclear who you'd put in charge of this.
I think I could have made it clearer. You know, there is that saying, everything's leadership's fault. So I'm the leader, ultimately lead. These two people reported to me. But I think in practice, I saw Andrew Hagger as having the relationship and the knowledge of the issue. So what Sharon Cook was doing here, I think Mr. Hodge, was giving an update to the board in a more procedural way. The specific decision, or the letter of 13 April, the specific piece around pre-FOFA, your earlier challenge, I think that was based on Andrew's belief that in discussions with ASIC and specifically Peter Kell, that they were open to this approach. Now, I also think in hindsight that was incorrect anyway. Right? Leave aside whether we were encouraged to or not. And so it's that sort of conversation and that sort of relationship that was being brought into the room where Sharon Cook and Andrew Hagger and others were in the bank, senior people considering this. So my point is, Sharon was clearly giving updates to the board. She would have been knowledgeable about it. She was giving, it was more a procedural update. Whereas the specific piece around pre-FOFA, that bit in the 13 April letter, I think that was based on Andrew Hagger's belief and recommendation, which Sharon ultimately accepted, was that there could be a pre-FOFA, post-FOFA distinction. And
what is the basis for your belief that that's what the source was of this pre-FOFA, post-FOFA distinction? That is Mr. Hagger and his conversations with Mr. Kell.
I think it was based on, conversations that Andrew Hagger had with Peter Kell to try to...
I'm sorry,
was that...
I think we're at cross purposes. How is it that you have come to know that that's how it came about?
Because I think I subsequently asked the basis on which we do this pre-FOFA, post-FOFA distinction.
When did you do that?
No, I can't recall, Mr. Hodge, sorry.
If we go back to your witness statement and bring up page 64, paragraph 220.
Yes.
And you see the first part of that says the remediation
Yeah.
methodology set out in the letter was advocated for by Mr. Hagger following discussions he had had with Mr. Kell of ASIC. Now, I understand that is the Commissioner, sent a notice to produce requiring any documents to be produced recording Mr. Hagger advocating for the remediation methodology set out in the letter dated 13 April 2018 as referred to in paragraph 20 of your draft statement, and no documents were produced. Are you aware of that?
No.
Does it surprise you that there'd be no record of Mr. Hagger having advocated for that?
Yeah, I could see because there would have been a group meeting on this. It may not have been minuted. If it was minuted, I would expect if there was a minuted item, if there was a record of the meeting, I would have expected that. But if there's no, particular meeting where that was decided, then I suppose the letter itself is the record of that's what we wanted to do.
Yes, it's the record of what you wanted to do. It's not the record of Mr. Hagger being the advocate for it, is it?
No.
And then, if we then bring up paragraph 221 of your statement, you say, in particular, the possibility of adopting a methodology that distinguished between the circumstances existing pre and post FOFA had been the subject of discussions between Mr. Hagger and Mr. Kell of ASIC prior to the letter being sent. As a result of these discussions, Mr. Hagger understood that ASIC was potentially open to such an approach.
Yes.
And your basis for that statement is you think something that you recall Mr. Hagger having said, or you having challenged at some earlier time why this was the methodology proposed?
Well, I think is your question on what basis do I make this statement?
Yes.
Yeah. Well, I think in the preparation for my appearance, Mr. Hodge, I did meet with Andrew Hagger, Sharon Cook, and others in the wealth business to obviously try to understand all these matters, and I asked Andrew specifically at that time. But going back to post 9 May when we received that letter from ASIC, when clearly they were deeply unhappy with that particular piece. I think I did talk to him then and Sharon Cook about why we had this pre-FOFA piece in there. So I rely on both those pieces, and probably more, but they're two particular pieces I'd rely on.
Can we just bring up the letter again, which is asic.0039.0001.1727? And then if we go to the top of, if we look at the bottom of page 1, you see this is proposing that split post-FOFA and pre-FOFA method.
Yes.
And then if we go over to the top of page 2, you see the first sentence is, I recognise that you may not have anticipated that NAB would adopt this approach for pre-FOFA customers given the direction of our previous discussions.
Yes.
Do you find it easy to reconcile the proposition that is explicitly put in the letter, which is that this would be unexpected for ASIC, with the proposition that this is something that had previously been the subject of discussions between Mr. Hagger and Mr. Kell, and that Mr. Hagger understood that ASIC was open to the approach?
I think the only insight I can give on that, Mr. Hodge, is I don't think the letter was not sent to Peter Kell. He was copied on it. I think this was to, if we can go back, is it to...
Yes, let's go back to the first page.
Louise Mullally, is it?
The third page.
Louise McCauley? Oh, yeah, Mullally, Tim Mullally joined the board, and Peter Kell, that's correct. I think Andrew Hagger had said to me that Peter Kell had indicated he was open to it and to make sure he was copied on the correspondence. But I think the lead was probably from the other two people on this letter. So I think that's the only nuance I could say in answer to your question about the first sentence on the second page of the letter.
In terms of other executives that had responsibility, was Mr. Cahill involved in the negotiations with ASIC?
No.
Mr. Gall, the Chief Risk Officer, did he have overall responsibility for NAB's relationship with the regulator?
Yes, he does, or he did.
And would he have been involved in the decisions regarding what methodology would be put to ASIC?
I think it's unlikely.
Ms. Cook was the executive accountable for remediation at that time? Is it the word accountable? That
No.
we're laughing
I'm
at?
just. Now you're on remediation,
Yeah.
which, as opposed to the negotiations and discussion with ASIC.
Yes.
Is
This
that-
is about remediation, isn't it?
But we hadn't agreed the terms.
I see.
But we're trying to agree the terms. It's taking a long time, but we hadn't agreed the terms. That's what we're trying to get to here.
Yes.
So, perhaps do you mean who's accountable for to get the
Let's take
agreement?
remediation. Who was accountable for remediation at that time?
Well, I don't think we'd formed formally the Centre of Excellence for remediation, and that's what Sharon and one of our senior team lead. So now there's accountability that Sharon Cook has for remediating the customers in ASF and other material programs, as well as the business. So our pre-lunch discussion, Mr. Hodge, about, there's always the two groups. So, but Sharon Cook clearly has accountability for that now. But I'm not sure at this point whether I can't recall the date. It may or may not have. I don't think so. That went subsequently to the board.
One of the things you say in your statement is that the proposal represented a good faith attempt by NAB to resolve its dispute with the regulator and remediate customers appropriately.
Yep.
Is that still your view today?
Well, I think I've said things in here, Mr. Hodge, about the pre-FOFA piece and about a couple of references to tone. That's how I stand on those. What I was trying to say here is I think Andrew Hagger and others did believe that this was a possibility and were acting in good faith. That's the piece I was trying to say. Now, I think in hindsight, it wasn't the correct approach. I believe that. But at the time, I think Andrew Hagger was trying to work through a complex issue and dealing with the regulator and trying to conclude. He had the right intent. That's the good faith piece. Do you see my distinction between the two?
Yes. By the time this letter was sent, ASIC had already told NAB a number of its approaches were not acceptable, including an opt-in approach.
Yes.
And can I suggest it's obvious, isn't it, that if an advisor has not provided the services promised under a contract, they should refund the fee that's been charged?
Well, you're right. The onus is on us as the provider that if we say to a client we're going to do certain things, we should do them and we should be able to prove we did them.
You know, and I think this is something that you are particularly willing to acknowledge was mistaken. You know that this letter attempts to justify treating pre-FOFA customers differently on the basis that NAB could have just kept them on commission-paying arrangements. That's right?
Yes, that's the argument in the letter.
Yes, and you agree that's unacceptable.
Yes.
And can I suggest this to you? It's beyond simply unacceptable. It's absurd for NAB to be suggesting that it would not simply refund the fees that it had charged for services where it had no evidence of having provided those services on the basis that had it just stuck with commissions, it could have kept the money without having to provide a service.
Well, absurd's the word you've used. I mean, I think when you look back at it, Mr. Hodge, I acknowledge we got this wrong. I think we were trying to, we had the right intent, but we were looking at it too narrowly and too technically. And once you look back on it, you see it's obvious. There was a lot of complexity in it. I think that's the other thing. We were dealing with 85,000 customers, went back to 2009. It was a pre-FOFA, post-FOFA world, leaving that as the argument aside. So it was one of the most complex things we've ever had to face into. But I think when you look back on it now, we could have resolved it a lot quicker.
Why was it so complex? What was it about it that you say was complex?
Well, Commissioner, there was 85,000 clients.
That's big rather than complex, I think.
Well, the files were complex, because what we're talking about here is financial advice on complex matters for people. It went back to 2009. We had a number of leaders involved in the business over that time. By the time we came to really face into this, a lot of those had left. We didn't have very good systems, Commissioner. We didn't have digitisation like we do now. We had to go back to hard copy files and couldn't always find them, and the advisors had moved on, or the NAB FP planners had moved on. We couldn't always find the file. So it was big and messy and complex. And I'm sorry about that, because that's not good enough on our part.
The other fundamental issue with it was that there was a revenue issue, wasn't there?
Yes.
And can we bring up NAB.030.002.6347? So this is a memorandum for the board summarising material regulatory engagement in December 2016. And if we go to the third page of that document, we see it's proposed by the General Manager of Regulatory Strategy and Affairs and supported by the Group Chief Risk Officer. You see that, Mr. Thorbank?
I do.
And then if we go back to page 2, we see in the middle of the page a section which is advisor service fees.
Yeah.
Which is summarising at that stage where the negotiations were at, NAB's proposal of a fair exchange of value, and that ASIC had said that wasn't customer centric and not acceptable. And you see NAB is considering its position and the potentially significant implications, including potential revenue at risk and compensation payable under various scenarios. And was that ultimately the thing that was the real problem, that to agree to an acceptable methodology with ASIC was just going to cost the business more than it wanted to pay?
I actually don't think that was the reason. I don't think that was a sort of conscious or openly discussed matter, Mr. Hodge, through this. I think
It was openly recorded in a memorandum to the board.
yes, but I felt your question was more pointed to were we withholding it, and I don't feel we ever did that. I feel that I think it's a factor. It fits with my first 4 points on my letter to the Commissioner. And I think is ultimately why, when we look back on it, there were consequences applied for myself, the CFO and the CRO, as well as others more directly involved, like Andrew Hagger and Sharon Cook this year. Because once we look back on it, we say, if we had have provided funding much more quickly, that would have opened up the possibility that this could be capability and resources could have been put to it. However, I do think that the bigger problem, not the bigger problem, the main driver was trying to get to the technical conclusion about what's an offer, when was it made, what's a review, what's the definition of that, how do we have to prove it? You know, if we send an email to say we offer this and the client says nothing, do we have to go back to them? If they reply, is that enough? So I think it was more in that technical world. Now, when you step back from it, you say, well, you know, that's really not the right way. We should run a trust-based stewardship business, right? However, other people at the time were trying to navigate their way through that, and they were in it. So I think that was the main driver. It wasn't this one. I don't think this was a conscious, openly discussed constraint.
I tender that document, Commissioner.
And before we deal with that, the memorandum for the Board Risk Committee, has that gone in previously?
I'll tender that as well, Commissioner, thank you.
Memorandum for Board Risk Committee dated 28 April 18 concerning advisor service fees, NAB 006-023-0062, Exhibit 7.85. Memorandum for Board Material Regulatory Engagement, December 2016, NAB 030-002-6347, Exhibit 7.86. Mr. Thorburn, whilst we have this on the screen and popped out in this fashion, direct your attention to the last sentence in the pop-out.
Yes.
What do you make of that?
The last sentence?
Yes, in the context in which it sits.
Well, I take that, Commissioner, to mean if we look at our small and limited peer group, some are like us. I have not been able to reach agreement on the methodology. Now, I think that's false comfort. That should not be the way we think of it now, but I think at the time that was noted. Whereas one had agreed to move in a more specific and decisive way.
With a very simple criterion, the service was either provided or it wasn't.
Yep. That's correct, Commissioner.
Do you think, I'm sorry, Commissioner, you didn't
No,
have...
go on.
Do you think, Mr. Thorburn, reflecting on that letter of the 13th of April 2018, that was an ethical approach for NAB to take?
I think the very particular issue there was the pre-FOFA, post-FOFA one. I think the discussions that Andrew Hagg and others had over time were such that, like, I don't think we listened to the regulator enough clearly in hindsight. But it wasn't as clear-cut as when we look at it now, that we said something and then they wrote something back, and like it wasn't moving that quick and sharp. So I think I come to this point around good faith. I believe it was Andrew Haggers and others' intent that we would solve this, that even these things like value exchange were what did the client get for it. If we couldn't get the specifics, like the Commissioner challenged me on, like, you know, we either provided or we didn't. If we couldn't find that, you know, is there some other way we could look at how did the client receive a service we provided and what's the worth of that? So I don't think it wasn't ethical. I think Mr. Hagger and others were truly trying to find their way through a complex set of issues inside and outside the bank with the regulator. I think I would say that we haven't shown our clients enough respect and probably haven't earned their trust through the way we've dealt with this. I would agree with that. But I don't think we were intending to create this issue and to be, in your words, unethical. No, I don't. The people have dealt with on this, Mr. Hodge, I believe are ethical people and bring ethical principles to work.
I don't think I said, did you intend it to be unethical? I'm attempting to assess with you whether when you reflect on it now, regardless of what the intention was, this was an ethical approach.
Well, it depends what you mean by ethics. I don't... Now, that to me still comes to integrity, intent, doing what we said we'd do, and I think there was here an interpretation of what that meant. Like, what does it mean? And I think it ended up being too technical and too legal. But the way I think of ethics, I don't think this was unethical. I do believe the outcome of it is that we have not earned our customers' trust. So maybe we're sort of agreeing in the essence of this without the specific word.
Do you think it was, to set aside the word ethical, do you think it was doing the right thing?
No.
Okay. Do you think that the fact that you were not doing the right thing is something that should have been recognised by the senior executives?
Yeah, I do. Well, in hindsight, now I look at it.
Do you think...
I think that at the time, Mr. Hodge, they thought they were doing the right thing.
Well, it's not just when we... You have a tendency when you've been answering these questions to always emphasise the name Andrew Haggar and then say, and others, and we'll explore that in a moment. But in terms of the people involved, the letter was sent under Ms. Cook's name.
Yes.
The letter is, you may disagree with this, but it does not look like a letter drafted by Mr. Haggar.
I don't know who drafted it.
The approach was one that you were aware of?
Yeah, I don't think I saw the letter before it went. I was aware of the ongoing discussions, yes.
But you know that you were at the Board Risk Committee meeting on the 30th of April where it came to the Board Risk Committee and Ms. Cook reported on it. That's right?
That's correct.
And this specific issue of a different approach for pre-FOFA clients justified on the basis of NAB's early adoption of fees for service was discussed at that meeting.
Yes.
And Mr. Gall, the Chief Risk Officer, was there.
Yes.
And as I understand it, nobody said then, this is not doing the right thing.
I'm not sure at that meeting, but the board have challenged us on this. But to go to your specific point, I don't think so, no.
Because then what changes everything is that on the 9th of May 2018, ASIC sends a letter back which unequivocally rejects the proposal. That's right?
Yep, and before that I met with Mr. James Shipton on the 26th of April, and that was an important conversation.
And after the letter on the 9th of May 2018, you then had Ms. Cook take over fully the conduct of the remediation. Is that right?
Yes, the finalisation of the methodology with ASIC.
And what it seems like is that somebody looking at your statement and listening to the evidence that you've given today might think that you are, to the maximum extent possible, passing responsibility for this to Mr. Haggar, the senior executive who has been made redundant and left the bank. Is that what you're doing?
No.
And that you're not recognising that even if Mr. Haggar had been responsible for suggesting this methodology, that at least 3 senior executives who are still at the bank were aware of it and attended the board risk committee meeting which considered it, and they are you and Ms Cook who reported on it and Mr Gall.
Yep.
And that you don't seem to have asked yourself the question, why couldn't we three see that we were not doing the right thing?
Well, I think I see that now. Your question is, when we were in it on 30 April, why couldn't we? And I think that was a combination of reasons. So there was a number of people involved, Mr Hodge. It's not just Andrew Hagger. Sharon Cook was closely involved. And they were the two who had sort of day-to-day responsibility for it. I have ultimate accountability, and David Gall, as Chief Risk Officer, does have some responsibility as well. But at the time, I just don't think we saw it with the clarity we do now. You know, it was an agenda item on a busy board schedule. It was a matter that had been going for 2 years. I think I delegated that, believing that we were getting close to a conclusion. And so that's the best I can say about, you know, often it's in, as you get through and you look back. And that's why this process, Mr Hodge, of my witness statement of really going back and looking at it, I think it's been a challenging exercise for me to really look at it and find out where our failings have been. And I think this has been one of them.
The particular issue I'm trying to get you to turn your mind to is accepting, as you say, that no one could see at the time that what you were doing was not the right thing. Why that was, and then of course that leads to another question, which is what that says about your organisation and your leadership going forward. So, as I understand it, what you say in, I use the word defence, I don't use that in a loaded way, but what you say for you and Mr Gall is that you were considering this at a busy risk committee meeting and not perhaps seeing it in the context of an agenda of things and where the process had been ongoing for exactly what it was. Is that a fair summary?
That was one of my responses.
And are there other things that you want to say about why you think you or Mr Gall couldn't see the issue?
Well, I don't think Mr Gall or I had been involved in the detail of the discussions with ASIC on this matter at all, apart from my 26 April meeting with Mr Shipton. It was one of a number of remediation exercises that we were undertaking, and it was one of a number of regulatory matters that we were complex and were material that we were dealing with. So it was one of a number of things that we were grappling with at the time and have continued to over the last couple of years.
And those explanations presumably can't account for why Ms Cook couldn't see that this was not the right thing to do, because she's not just an attendee at a busy meeting. She's not abstracted away from it. She's directly involved. So have you considered why it is that she couldn't see that this was not the right thing to do?
Well, I would give similar answers. I think Ms Cook, she had broader responsibilities, Mr Hodge, and was involved with this, but more as a partner at this point in the time, or in the few months prior to this, rather than the lead on it, and she hadn't been involved in the previous couple of years of discussions around it that the wealth business had had. So I can't answer your question, why did Sharon Cook not see it? I can only give a view about why she may not have.
But as the CEO, isn't it important for you to understand and have confidence that all of your senior executive team are able to know what the right and wrong thing is to do?
Well, I do have confidence in my team to do that, Mr. Hodge, but we're human. We're going to make misjudgments. We're not going to get it all right. And then it's a question of learning from that and changing the way we do things if we've made mistakes.
But the learning requires reflection, doesn't it? You have to go
Yeah,
back and understand why things happen.
Yeah,
in the
and I
first
think we
place.
have. We have a lot.
And ultimately, I think you'd agree, if one of the problems within the business has been a failure to challenge decisions and to make sure that the right thing is done, that's something that has to start at the top.
Yeah, and I think we're learning to do that, Mr. Hodge, to bring challenge into the room, to do that respectfully, to do that with precision, to make it not personal. And I think the voice of risk and the voice of customers is being heard a lot more inside our company today. And that is something that we need to keep working on, because I think in the last couple of years, when you look at these cases where we haven't got it right, there's a few common principles that we've missed, and that's one of them.
You've now agreed on your remediation method for NAB financial planning,
Yes, we have.
but you haven't agreed on it for the other 4, or for your 4 licensees that have authorised representatives under them.
Yeah, that's right.
And why is that?
Well, why is that? Well, I think the primary reason is that we took the view that the methodology would be agreed first on the NAB FP business, and then it would be applied into the advice partnerships business. So we'd sort of work out how to do it, and then we'd deploy that solution into advice. I think that's the primary reason. The second reason is that these are not our employees, the advice partnerships personnel, where they're under our licence. So we have less direct authority to look at files and get access to data and information. And also, it's part of a wider industry matter, because only 35% of the planners in the marketplace are actually, attached to banks. So there's a wider issue that I think there's industry work on, seeing if the principles and the methodology, if you like, could be agreed once and for all.
Let's just take the first reason. The first reason was, as I understood it, that you wanted to agree on the methodology for NAB financial planning and then apply that to your other licensees.
Yes.
You agreed on the methodology for NAB financial planning in June.
Yep, June. Yeah, I think. Well, yep. I think maybe not concluded for a couple of months after that. But yeah, I think we got pretty much there in substance then, Mr. Hodge. Yep.
And ASIC has said that it thinks you should apply the same methodology to your licensees.
Yes.
But as we understand it, you haven't yet agreed to that.
No, I think that is in active discussion with ASIC though right now, Mr. Hodge. That's
So your first explanation, which was we needed to agree on the methodology for NAB financial planning and then we'd apply it to the advice licensees, can we put that aside as not being accurate?
no, I think it's very accurate.
You don't want to just apply the same methodology that you've agreed for NAB financial planning to your advice licensees.
We wanted to agree the methodology in NAB FP and then put it into advice partnerships, and that process of discussing that with ASIC and getting agreement is underway.
Isn't the real nub of this the second point, which is there is a problem, and the problem is you don't have records for your advice licensees, which makes it financially very difficult for you to agree to apply the same methodology for NAB financial planning to your advice licensees.
Well, I'm not conceding the first point. I still believe that is what we have done. But on this point, this is a material point, that they're not employees, they're under our licence, and to get access to files, and especially going back in time, it's a bit harder. Yeah, yes.
And so for that reason, you can't just apply the same methodology you've agreed for NAB financial planning over to the advice licensees, because there's the real possibility you'd have to repay almost all of the ongoing service fees that you've taken over the course of 6 years.
Well, Mr Hodge, if we've taken fees that we didn't deserve, that's the answer. Like, we've just got to go through a process to find out what the answer is.
The problem is you've taken, I might be wrong about this, but I think it's something in the order of $600 million, haven't you, of ongoing service fees through your advice licensees over a 6-year period?
Yeah, I don't know that specific number, but...
In any event, it's in the hundreds of millions, it must be in the hundreds of millions of dollars, you agree?
Yes.
And the problem with the methodology is that the premise of the methodology you've agreed for NAB financial planning is that if you don't have a record of service being provided, you're going to refund the fees.
Yes.
The problem, if you tried to apply that over to your advice licensees, is that you just don't have any records, or very few records, inadequate records.
Well, I think we don't know that yet. I think that's the process we're going through.
So you know you don't have the records.
Oh,
The question is whether you
does the
can
advisor
get them
have the-
from someone else.
Yeah, so that's what we have to go through to get access to those files, paper and otherwise, and with the turnover of those planners over time and moving to other, other advice partnerships, there's some challenges there. But that's what we have to do. Go through that process.
And am I right in thinking then you're not willing to agree on just applying the NAB financial planning methodology over to your advice licensees until you've reached some sort of resolution about being able to get access to whatever records your authorised reps have and seeing the extent of those records?
No, I think, as I understand it, what we've done with NAB-FP, we've got some very particular now definitions about what is, advice, what is a financial statement, what is an offer of an advice. That ended up being quite important distinctions, Mr Hodge, in what is the methodology. So we have that. That's like base case. So now what we have to do is apply that into the advice partnerships and see what the outcome is.
But there's a reason you haven't done that. I mean, you could just say, we'll apply the same methodology. You could do it right now. You could commit to it right now, couldn't you? You could do it today.
Yes, but then we have to find out what information we have and what files there are, because these were independent planners under our licence. They may well have far better records than what we had, ironically.
What I'm trying to get at with you, Mr Thorburn, and I don't think you're disagreeing with me, is that you want to know what the records are first and figure out how you're going to get access to them before you will commit to the methodology.
That's not the way I understand it. As I understand it, we have a methodology, and now we are going into the advice partnerships business to determine, once you apply that methodology, what do you find?
And you speak in your statement of an industry solution.
Yes.
What is that?
Well, as I understand it, the FSC, Financial Services Council, which is the amalgam of sort of advice-type partnerships for the industry, beyond the banks, this is a common issue. It's a common question that's been put to them by regulator and clients and planners. So I think there is a view that if they could sort of agree that it's done properly, thoroughly, professionally within the sector, that will cause the whole thing to be resolved in a much quicker way.
I'm sorry, I'm still not sure I understand. What is the industry solution, though, to this problem?
Well, I don't think they found it yet. I think that's what they're working through.
The solution is something to do with trying to identify what the records are and what will constitute an acceptable record.
Yes, and getting access to those, and if people have moved from one platform to another, you know, that people work together to get the information we need. Does that make sense?
I understand.
Yeah.
I don't have any further questions.
Thank you, Mr.
Thorburn.
Hodge. Yes, Ms. Harris?
No re-examination,
Yes.
Commissioner.
Thank you very much, Mr. Thorburn. You may
Thank
step
you, Commissioner.
down.
Thank you, Mr. Hodge.
Now, Mr. Hodge.
Commissioner, the next witness is Mr. Henry. Could we take a 5-minute?
I come back at say 3:05.
Thank you, Commissioner.
Yes.